Yeah, good evening. I hope you can hear me. Good evening, can you hear me?
Yes.
Yeah. Okay. Okay, so we'll continue from where we left off yesterday.
Kindly mute everyone. I think I've seen some having their videos on, so you can mute their videos.
Okay, so let's continue from where we left off yesterday. So we'll proceed with IAS 12. IAS 12, income taxes. Income taxes. So first, let's do a recap on income taxes, and then we solve the questions. So IAS 12, as you know, is made up of two major types of tax. We have the current tax and that of the deferred tax. So we start with current tax. How do we get current tax? So to get current tax, here is basically going to be your taxable profit. Then you multiply by the tax rate. Taxable profit, then you multiply by tax rate. And we always say that yeah, whenever you are giving accounting profit, you need to change your accounting profit to taxable profit before you apply the tax rate on it. Then we said, yeah, if your answer, the default here is that you should get a current tax liability, which you should report under non-current, under current liability. But in the case whereby you calculate on a taxable loss, that's in the case whereby your answer is negative, then you get what we call current tax assets. And this should be accounted for under current assets. So this in terms of the presentation, the financial statements, the positions precised to. So this is for current tax. Then we spoke about deferred tax as well, where we said deferred tax is calculated using either three things. We said three things. It's going to be your temporal difference, unused, unused tax losses, and then credits. Let me just end it here. Unused tax losses and credits. Then you multiply by the tax rate. So we indicated that yeah, we can get deferred tax from three major sources: temporal difference, unused tax losses, and unused tax credits. You made mention that unused tax losses and unused tax credits automatically gives you deferred tax assets. Okay. But temporal difference, it's only when the temporal difference is a deductible temporal difference, then it will give you a deferred tax assets. And we spoke about how to get temporal difference as well. Just to get temporal difference, yeah, it's going to be current, your current amount less your tax base. So when you take the current amount of your assets and then you deduct by your tax base, it gives you your temporal difference. And then you report it as such. If you get negative, the resultant answer will be a deferred tax asset. But if it's a positive, which is the default, that becomes a default, deferred tax liability. So we spoke about this. So let's go to the question. Let's see what we have. Can we get a reader for the day? Can we get a reader for the day?
IS-12 income taxes. The following information relates to the income of Flourish Limited for the year ending 31st December 2021. The following are relevant for the above statement. 1. The other income is made up of 80% dividend receivable from overseas investments, which are taxable on receipt. The short-term remainder is from interest received on short-term investments. Please scroll up. A third of the electrical bills was in arrears at the end of the financial year. During the year, Flourish Limited bought computers and printers amounting to 4 million Ghana cedis. Depreciation and capital allowance charges for the year are captured in the schedule below. Four, Flourish Limited sponsored the Dean's Award scheme at the University of Technology with 100,000 cedis. The remainder of the donation was used to sponsor a political party in the general elections. Required. Prepare Flourish Limited's tax liability for the year ended 31st December 2021, assuming a corporate tax rate of 25%.
Yeah, thank you very much, Arida. So for this question, we need to ascertain the current tax and that of the deferred tax. That will help us. I think I made a little adjustment to this question, but I didn't indicate that for all of them. Give me a minute. Yeah, so yeah, if you calculate it very well, you should get here as 46,000. So you can correct that if you have printed that. It's 95 minus 2. This should give you like around 67. Yeah, so I made a little changes to this question. So here should be 67. When you add 3, that should give you 70. That should give you 70. And the final answer will come to 46,550. Okay, so we'll use 46,550 as the profit before tax to calculate for it. So yeah, we have been given these statements, or let me say, yeah, this income statement. Bear in mind that we said to get current tax here, you need to bring your taxable profit. And we say taxable profit is a profit determined using the rules provided by the tax authority. So this is what the accountant has gotten as his profit before tax, 46,550. We're not going to use the 46,550 as the taxable profit. We need to adjust this to a taxable profit. And the question is, how are we going to do that? How are we going to do that? So remember, I gave you an approach to convert your accounting profit to taxable profit. And how are you going to do that? You bring your accounting profit before tax. Then you adjust this accounting profit before tax. So in adjusting it, you're supposed to add any income which is taxable, but you have not recorded. So, but not recorded. So in the tax authorities, if they have any incomes that are taxable, but they have not recorded, you add it. And you less income which are not taxable, but you have recorded them in the books. So you less those ones. Then we come to the expenses to same with expenses. You are going to less expenses, which are taxable but not recorded. And then you are going to add back expenses, which are not taxable, but you, the accountants, you have accounted for them. So if you quite remember the last time I made example as depreciation, the tax authority don't record depreciation, they record what you call capital allowance. So we use that as a case study in that case. So what we are going to do here is to do the conversion first from accounting profit before tax to taxable profit using our question. So we'll do that over here. We need to convert to taxable profit. So using the same approach, we'll first bring our accounting profit before tax. That will be 46,550. So 46,550 over here. Then we adjust it. So yeah, in adjusting that, we need to make use of what has been given to us in the statement and then what has also been given to us in the additional information. So we'll start with the income item. Yeah, we only have other income here, which relates to note one, the additional information one over here. It says that other income is made up of 80% dividend receivable from overseas investments, which are taxable on receipt. The short-term remainder is from interest received on short-term investment. Yeah, so my question is the whole income taxable? Is the whole income taxable?
No.
Is the whole income taxable? Yeah, they're saying 80% is dividend receivable from overseas. Receivable means you are yet to receive it in that regard. So it's all the other income. It's all of it taxable.
No,
Yeah, Isaac, what are you saying, no?
because they are saying that the it's supposed to be taxed after it is received, but it is still a receivable. That means that it has not even been received yet, so it is not taxable.
Exactly. So they indicated that the tax authority regard that they are only going to tax it when it has been received. But yeah, this is dividend receivable, meaning you are yet to receive this amount of money. So we need to disallow the 80%. And how do we disallow it? Bear in mind, it has been accounted for as part of the 3,000. So if you are disallowing it, yeah, it means you have to get less it from your profit before tax. So with our profit before tax figure we have here, we need to less the income, which is not taxable, but we have recorded. And here, typical example is a dividend receivable. That question has drawn our attention to. And yes, it's making up of 80% of the figure. So it's going to be 80% on the 3,000. What are you going to get in that regard?
2,400.
2,400. We show this as negative. In that regard, we show this as negative. The next is we check. I think the income that was all. We are not having any other income in this question. Then we check the other information. Hey, we have 3 zeros on top. Let me do that. Yeah. So Ghana say 3 zeros on top here. Let me do it 2 here. So I think for the incomes, we are done with it. We can find a subtotal for just the income aspect, which will be this plus this. Then we go to the expenses aspect as well. So we have to check the expenses. If there are some items that are not supposed to be brought here, by default, depreciation you know that the tax authorities do not regard depreciation. What they regard is capital allowance. So by default, we need to less the depreciation figure we have gotten from here, and then we need to disallow that amount and rather report the actual capital allowance that the tax authorities will regard. So this depreciation here, we need to disallow it, meaning we need to add it back in that case. So we come to the expenses aspect. To add expenses that are not taxable but recorded. So yeah, we made mention of a depreciation. We'll bring the figure here. 7,000 here. Remember that we have to calculate for the actual. So there, I'm sure note 3 will give us details on how to get a capital allowance. You can see why we have been given capital allowance rates, meaning that we have the rate you are going to use. We use each rate to calculate for the capital allowance. So let's finish with the expenses which are not taxable. When we are done, we calculate for the capital allowance in that case. So we'll go through the other items and see what we have in the additional information as well. So additional information 2, let's start from 2. Yeah, we're told that a third of electricity bill were in arrears as at the end of the financial year. We're in arrears as at the end of the financial year. Now you should bear in mind that electricity bill too, just like the dividend here, electricity bill here, that is in arrears. You can't pay tax on the 1 year, that is an arrears. You only pay that when you make the payments for the electricity bill. So electricity bill as well, we need to disallow the aspect that was in arrears. And yet we have been told that the aspect in arrears is a third. If you are representing a third infraction, what's that? What's that going to be?
1/3.
1/3. So that will be 1/3. So we'll bring our electricity here. So that's 1/3. Then we multiply on the bill for electricity, which is 2,700. Then the next we have here is during a year flourish. So this one relates to the depreciation. We'll come back to that. We go to additional information 4 here. Additional information 4 here. We're told that Flourish Limited sponsored Dean's Award Scheme at the University of Technology with 100,000 Ghana cedi. The remainder of the donation was used to sponsor a political party in the general election. So, according to the tax authorities, they only regard the donations which are of worthwhile causes. So, donations for educational activities, that's fine. But the donation to political party, that is not regarded as a donation under the tax law. So for that one, we need to disallow the donation that relates to the political party. So yeah, they have told us that 100,000 relates to an educational award scheme, but the rest, which is the remainder, was for a donation we made to a political party. So yeah, we need to less this 100,000 from the donations we have here. Yeah, it's supposed to be 1,000. 3 zeros on top. So 1,000 minus the 100,000 here will give us 900,000, right? That'll give us 100,000. So we'll do that here. The donations here to political party. We are going to disallow that. That will be 1,000 minus 100. The electricity, what do we get? The 1/3 on that. What will we get as an answer?
900.
900.
900. And then the donation will also be 900.
Mm.
We sum and bring the total here. So it's going to be this plus this plus this. Then the next we come to is the expenses. We need to less the expenses which are taxable but I have not recorded them. An example is the capital allowance. I said we will have to look at the capital allowance, but not recorded. So we'll have to go and do workings for capital allowance. So let's do the workings somewhere down here for the capital allowance. For the capital allowance, we check the policy. So here we're given a column for capital allowance rate for each of the assets. And then we do that for each asset in that case. We do that for each asset in that case. But we're told that during the year we bought some of the assets. So during the year, Flourish Limited bought printers and computers and printers amounting to 4 million. So we have computers and printers over here. We have computers and printers additional over here of 4 million. We have 4 million. Where are we going to classify that? Yeah, these are the ones we have here. Where are we going to classify that?
Office equipment.
Financial.
Relax, raise up your hand. So I'm talking about the assets. Which of the assets does it belong to? Yeah, Isaac.
Office equipment.
Office equipment, definitely. So it relates to your office equipment. So during the year, they bought that as part of your office equipment. So yeah, when we're calculating the capital allowance here, bear in mind that we need to calculate this 100% on the 4 million. That's the one for the year. This was the cost we have within the span of life of the assets. But I'm supposed to charge 100%. And yeah, 100% here means that if we're charging on the 9 million, it means that in the previous year they will have charged all the 9 million left. So this year that we are in, yeah, it's going to be 100 on the newer one. So you don't have to charge on the old one. This old one in the past should have been finished. If the policy was 100%, means that it should be finished. But since we have a newer one, which is the 4 million, we're going to charge 100% on that 4 million. So we'll start with the office equipment. And for the office equipment here, we need to charge 100% here on the 4 million. Yeah, 3 zeros on top, so that's 4,000. And yeah, we will get 4 million back.
Hey, please, can you come again with that explanation? I didn't get it. The 100%.
100%. Okay,
Yeah,
so
I
first,
thought.
the 100% is already here. So the policy for capital allowance is 100%. Now, this office equipment, 9 million. If you calculate 100% on it, what will you get? You'll still get 9,000, right?
I thought
Yeah,
the 100% was related to the depreciation figure.
nope. Yeah, the percentage.
So I was thinking we had to take 100% of the depreciation value. That was what's confused me.
Oh, no. So that's what I was saying. The 100% here will have been calculated on this 9 million. That will have been the idea. But bear in mind that you already have a depreciation figure here. That should tell you that in the previous years, they already had the assets existing. And if it's 100%, means that during the previous year, if you're calculating for the tax base, the assets should be finished by then. So that's why I made a statement that we'll only calculate it on the current value that they bought for the year. And during the year, they said they bought 4 million. And we all agree that this relates to office equipment. So we take it to office equipment. Yeah, Jerry, your hand is up. Jerry, your hand is up.
Okay, sir. So, sir, talking about the depreciation, the office equipment being 100%, does that mean they are recovering the amount in the first year?
Exactly, yeah.
Oh, okay. Thank you.
Okay. So that's the office equipment. Move on to the next one. Furniture. Furniture, yeah. The policy for capital allowance is 15%. So we'll do that for furniture. The furniture is 15% on the value. Jerry, let's finish, and if you have an additional question, take it. 10,000. So what are you going to get? What is, I think, 1,500 off. Yeah, Abby.
Yes, sir. Please, why are we using the amount here for the furniture, but with the office equipment, you were saying it's assumed it has already been absorbed for the year or something like that.
Yeah, because it's 100%. This is 15%. If you want to know the number of years, you are going to charge the 15% from. Do 100 divided by 15. You know the number of years the asset will be used for.
Oh,
But if you do
okay.
100 over 100, if you do 100 over 100, meaning the number of years will just be one, right?
Yes, please.
Yeah, so that's why I said the 9 million, it has already been taken care of in the past. So the only one you account for is just the current year.
Okay, so if the office equipment was to be like, say, 50%, we would have started it on the 9,000 as well.
Maybe it was
If the office equipment was, let's say, 50%, we would have
50%.
charged.
Yeah, we'll have charged it on the 10,000. Because if that was assuming that it has been used for 2 years.
Okay, all right, thank you.
Yeah, because 100 divided by 50 is 2 years, yeah. Okay, let's make it weigh 15,000, yeah. Multiply by the rate, which is 25%. Then we have land, which is 100,000, which is 2% here. So land, 100,000 on 2%. Come to building 150,000 times 20%.
About 7 stores. Oh, Ben is
Building is 150 on times 20%. So let's calculate what would be the capital allowance figure?
3,750.
Who are talking to? I couldn't hear anything. You just wanted one
3,750.
person should just 3,750.
Yes.
Land will be
2,000.
2,000. Okay. And building? I think that should be 30,000 now.
37,500.
37,500.
No, it's 30,000.
You know, 150,000. 20%. I thought 25%.
Okay, we sum this up. So this becomes our capital allowance here, which we'll bring here. Isaac, mute yourself. So this becomes our taxable profit. Then we'll calculate our current tax on this taxable profit. So current tax here will be, we'll bring the rate in the question. The rate of tax in the question here is 25%. So 25% on 11,700. So what will be our resultant answer for this?
2,925.
The 2,925. So that will be our current tax in that regard. Yeah, Joanna, you know.
I thought land was not depreciated. So why are we depreciating
But
it?
the tax authority say they charge 2%. So I'm not going to charge it.
Oh, okay. Okay.
Yeah, so that's what the tax authority is charging. So you don't have a choice but to include that.
Okay.
Okay. Let's go to the fair tax. Now you know how we calculate for the fair tax for the assets. We say to get the fair tax, we need to bring our temporal difference. Then we multiply it by a tax rate. And we know how to get temporal difference already. Temporal difference here will be the current amount of the assets minus the tax base. So we need to get the current amount of each asset, and we need to get their respective tax base as well. Then we get a temporal difference, and then we calculate for the deferred tax at the rate of tax, which is 25% in this question. So we start with each asset. We have office equipment. So office equipment. We'll first start with the cost of the office equipment here, which we have been giving as a 9,000. So it's going to be 9,000. Yeah. Then we less depreciation. In this case, depreciation for that was 500. So that was 500. In that case, you less that one from the 9,000 to get a current amount for the office equipment. We'll do the same for the tax base. So the tax base, we also know we have to bring the cost here. And bear in mind here, we are bringing the current year value, which is the 4,000. Yeah. Then we bring the capital allowance. Let me do here. Or capital allowance. So we'll bring the capital allowance we had. The capital allowance was 4,000, the same figure we had here. Then here, when we subtract, you get 0 in that case. Then we look for the temporal difference between these two. 8,500 and the tax base of 0. You definitely get 8,500 here as a difference. Then you charge your deferred tax on it, which is 25% on this value. And that will be your answer in that case. So this is for the first one. Then move on to the second, assets, which is furniture. So furniture, to bring the costs of the furniture, which is 10,000 here. The depreciation or capital allowance, depreciation here was 1,200. Do the same here, 10,000, and then we bring the capital allowance here to be 1,500. Look for their respective differences. Then we look for the difference between these two, this minus this. Then we calculate for the percentage as well, which is 25% on this. Then move on to the next class. Bring the cost of the cars here, which is 15,000. Bring the depreciation and capital allowance for each 2,000 year. Look for the difference here. And then we calculate for the rates. Then we get to the last last but one land. So we do land. We bring the cost and the depreciation. The cost of the land is 100,000. Let's see if we have a depreciation here. So land, we're not having depreciation for that, but we're having a capital allowance. And we get to the last one, which is building. So we bring the cost, which is 150,000. Then the depreciation for that was 3,300. Yeah, so this is the temporal difference and then the deferred tax. So we add all the deferred tax together, we sum all of them together here, which is from here through to the last one. So this is our deferred tax liability. So now that we know our current tax from the top, and then we know our deferred tax, we know our current tax here, and we know our deferred tax here, we have to add all of them together to give us your income tax liability, income tax expense. So our income tax expense here will be the summation of the two. So will be our current tax that we had. And then the deferred tax figure we had. So that is how we'll go about it. If there are questions on this, I'll invite it. Yeah, Isaac.
Sir, please, my question is on the office equipment,
Okay.
the deferred tax.
The deferred tax.
Yes. So my the carrying amount, I thought that since we bought a new asset during the year, we are supposed to add it to the carrying amount of 9,000, then calculate depreciation. I don't know.
So it's going to be part of the 9,000 here will be a combination of both the old and new.
Uh,
Yeah,
so
that
it's
will be
already
the
part of the
the
9,000.
yes, so it's part of the 9,000. Let me put it that way so that you get it. So these ones are balances of your assets. That was given to you in the question. So it's going to be part. The one for the year was going to be part. Unless the question indicated that it's not part. And I don't think the question said anything like that.
No,
Okay.
thank you.
You're welcome. Any other question? Okay, so that means we are fine. So the moral of the question is to help you to convert from accounting profit to taxable profit. Taxable profit. I think so far in the syllabus, I think I've only seen it once. Once, most of the time it's just the depreciation they bring. But bear in mind, it's not only the depreciation. Others can also come in this case. So that's it for this question. Move on to the next question over here. So let me move on to question 2 here. Rita, can you read for us? Question 2. So read
Okay,
the
question
preamble.
2.
Read the preamble, read the required, then we take them one by one.
Okay. Record. Complete the carrying amount, tax base, and temporary difference for each of the assets and liabilities, and calculate the deferred tax for 31st December 2018. The applicable tax is 30%. An entity, Care Limited, provides the following information regarding its assets and liabilities as at 31st December 2018. 1. A machine costs 200,000. Depreciation of 38,000 has been charged to date. Tax allowance 60,000 have been claimed. 2.
Okay, so let's finish with one. So this
Okay.
question, we're calculating for the carrying amount, the tax base, and that of a temporal difference. Then we calculate for the deferred tax for them. So if you quite remember in class, we solved a similar question in this case. We will just bring, I think that was even a past question. So we will bring the items each over here. Carrying amount, tax base, temporal difference, and our deferred tax. So we start with the first item. We have machine here. So for machine here, we calculate for the carrying amount of the machine. We have been given the cost of the machine to be 200. We have been given the depreciation to be 38. So to get a carrying amount here, it's going to be 200,000 minus the 38, minus the 38, 38,000. And that will give us, what are we going to get for that?
162.
Is that
62.
162,000? Then the tax base to be 200 minus the capital allowance for that. And here we have been given the tax allowance for the asset to be 60,000. So here we less by 60,000. And this will give us 140, right? So we bring that here, 140,000. And we look for the difference, which will give us the temporal difference, which will be 162 minus this 140. Then we calculate the percentage of tax on it. Let me see if the percentage of tax is the same here. Yeah, it's 30%. So let me change it to 30%. So yeah, 30% on the 22,000. Yeah. Then we move on to the second. We are done with the first one. Move on to the second one. So read that. Second one.
2. Interest receivable in statement of financial position is 5,000 cedis. The interest will be taxed when received.
So interest receivable in the statement of financial position is 5,000. The interest will be taxed. No, the first we need to get a current amount. So what's the current amount for the interest? So you are dealing with interest receivable. That's the second one. Interest receivable. So first, what is the current amount for the interest? So we have told you, you have given you a value already that in a position, this is the value you have recorded as your interest. So you just bring that there, 5,000 here. Then you come to the tax base. What is the tax base? If you know, raise up your hand. What is the tax base for this one?
0.
Isaac, your hand up.
Yes.
Your hand is not up. I can't see it. Yeah, Kojo, your hand was up first. So you can go ahead. Is Kojo there? Okay, then let me go to Isaac. Isaac,
0.
0. Why 0?
Because they said it will be taxed when it is received. And
When received. That's good. And this is interest receivable, meaning we are yet to receive it. So the tax base will be 0. We don't have a value for tax base. So our temporal difference will be 5,000. And then we calculate for the tax for that, which is 30% on the figure. Okay, let's move to the third one. I read out the third one.
Trade receivable have a carrying amount of 20,000. The revenue has already been included in taxable profit.
Okay, so carrying amounts for the trade receivable is given as 20,000. So we have trade receivable of 20,000. The next one here is the revenue has already been included in a taxable profit. So what's the value for the tax base? Based on that statement, what's the value for a tax base? So if we say the revenue has already been included in the taxable profit, what's the meaning for that for your tax base? Yeah, Isaac.
it means that the tax base will also be 20,000.
Exactly. It means your tax base, it means it's allowable, right? And it's 20,000 in that case. So yeah, temporal difference will be 0. The fair tax will be 0. Move to the fourth one.
4.
So read that.
Inventory has been written down by 1 million cedis to 9,000. Sorry, inventory has been written down by 1,000 to 9,000 in the financial statement. The deduction is ignored for tax purposes until the inventory is sold.
Okay. So yeah, what is the current amount of our inventory?
9,000.
Isaac, your hand is up.
Yes, the carrying amount will be 9,000.
Will be 9,000. So that's true. So inventory. Then what's the tax base? And what is tax base? Hmm. Yeah, Isaac, your hand is up.
The tax base will be 0.
The tax base will be what?
0.
Zero. Why are you thinking it's zero?
Okay. I thought it was the tax people that were ignoring it. Oh, they said the financial statement, the deduction is ignored for tax purposes until the inventory is sold.
Huh? Okay, I saw other hands up. Was it Zati or so? Was it Zati?
Yeah, the tax base will be 10,000.
10,000. Why 10,000?
Because they said the deduction is ignored by the for tax purpose, mean that a thousand should be added to the 9,000 that they
Exactly. So when
raised.
they talk about the deduction, Isaac, when is it the deduction here? They're referring to the write down of 1,000, not the whole amount. The write down of 1,000. So they say ignore the write down. So if you are ignoring the write down, meaning you're supposed to record the inventory in its full value. And what would be the full value? The full value will be the 9,000 plus the 1,000, which is the 10,000. So yeah, Zadi, that's correct. So you bring it here as 10,000. So we find a difference, this minus 10,000 here. And then we calculate for the deferred tax. Then move to the fifth one.
Hi.
I read that.
Current liabilities include accrued expenses of 5,000. This is deductible for tax on cash paid basis.
We are looking at carried expenses. So we're bringing here carried expenses. So yeah, we have been told that the carrying amount, what's the carrying amount value for the carried expenses? What's the carrying amount value? Yeah, Isaac.
5,000.
Okay, so I'll give you 1 out of 2. So if I'm marking over 2, I'll give you just 1. Because you left something out. Who knows that thing?
Is it minus?
Yeah, minus
Minus
5,000.
5,000.
It's negative. It's a liability. So you should bring it as negative. Negative 5,000. Then we come to the tax base. What would be the tax base? They told us that this is a deductible for tax on cash paid basis. On cash paid basis. So what will be the tax base? Yeah, Isaac, you want this up again?
0.
0, 0, 0. That's correct. 0. So I bring that here. And then we calculate for the declared tax in that case. Let's go to the last one.
Accrued expenses have a carrying amount of 5,000. The related expense has been deducted for tax purposes.
So here too is about accrued expenses. So bring it here. Yeah, what's the carrying amount here? Here too is be negative 5,000. So 5,000 here. Bring it as negative cost and liability. Then let's look at the tax base. What would be the tax base for the seat one? For the last one, what will be the tax base? Yeah, Isaac.
5,000.
1/2.
Negative 5,000.
Okay, correct. So negative 5,000. It says it's deductible for tax purposes. So you bring that, and then deferred tax will be zero for that. When we are done with some of our deferred taxes up,
Hey, sir.
so, yes, please.
Uh-huh. Shouldn't one of them be positive? I'm confused.
One of them be positive.
They accrued, yes. If they are negative, we'll get negative 10,000.
Accrued negative. Oh, so yeah, right, right. You get zero. You get zero, right? Negative 5,000 minus 5,000. That will be zero.
Okay.
Yeah. Esther, your hand is up.
So please, you've answered the question. So this was okay. Thank you.
Okay. So we are done with this question. We move on to question number 3. So I read out to you.
Question 3. Simple has estimated its income tax liability for the year ended 31st December 2008 at 180,000. In the previous year, the income tax liability had been estimated at 150,000. Refer, calculate the tax expense that will be shown in the statement of profit or loss for the year ended 31st December 2008 if the amount that was actually agreed and settled with the tax authority in respect of 2007 was A, 165,000, B, 140,000.
Okay, so this question is on under or over provision of tax. You may most of the time see this in your additional information. So I just brought this. You may see it in your additional information. We're preparing your IS1, the publish account. When you're preparing your publish account, you may see that's part of it. So just a recap on that. To get your income tax expense, apart from you bringing your current tax, and even for deferred tax, we say you have to bring your increase or decrease in increase or decrease in your deferred tax. So if it's increase, you add. If it's decrease, you less. The next thing you need to consider is under provision or over provision of tax. Under provision, you add. Over provision, you subtract. You sum these together to give you your income tax expense that you take to your full account. So yeah, you pick your current tax, you bring your increase or decrease, and bring your under over provision. So we say the case of under over provision states that always your current tax that you provide for is a provision estimate. So when you go to next year, that's when you get to know the actual you paid for. So in our question here, you realize that it will be mentioning last year's estimates. You mean you have to compare last year's estimate with what you got or what you actually paid for this year and check whether you under provided or you over provided. So we'll go to this question here. The question says that our income tax liability for the year, which is that first December 2008, was 180,000. This is definitely your current tax. The one for the year is the current tax. So if you are doing for this question 3, and we are starting with the A, and we want to get our income tax expense, we'll first start with our current tax, which has been given to us as 180,000. We were told that in the previous year, the income tax has been estimated at as 150,000. So this is the estimate for previous year. We need to compare with what we paid for this year and find out whether it will be underprovided or we overprovided. So this year we paid for the A. We are doing for the A. A says that we paid for 165. So yeah, did we underprovide or we overprovided? We provided 150 for last year. We actually paid 165,000. Yeah, Kojo? Kojo, you can unmute and speak. Okay, different person. I think Kojo might not be ready. I hand it up. Isaac, go ahead.
We underprovided
We underprovided. Why are you saying we underprovided?
because we provided less than we paid.
Less than what we paid. So this is definitely an under provision. So we bring our under provision of tax. And yeah, we bring the difference here for purposes of workings. So that's 165 minus 150,000. So that will give us 15,000. So yeah, we sum the two together. So this becomes our income tax expense for the A. Then we come to the B as well. We're given the same current tax, so I'll just bring that here. So let's check for B, whether we underprovided or we overprovided for B. So B, you're saying we should assume that we actually paid 140,000. So did we underprovide or we overprovided? Yeah, Isaac.
Overprovided
Why?
because we provided more than we paid.
We provided for more than we paid. What we provided as a provision for last year was 150, but we went to pay 140. So that's over provision of tax. So that's over provision. Yeah, we also bring the difference in this case. That will be 150,000 minus the 140,000. Difference here will be 10,000. We less this 10,000. We will get 170,000. So this is how you go about it when you have under provision over provision in your full account. Another way is that they may also put in your trial balance. So when you see a provision, maybe you see tax provision, and it's at your debit side. If it's at the debit side, it's under provision. If you see it at your credit side, it is over provision. Questions on that? Questions on what we have done? Okay,
Please
if there's
come
no
again with the
questions.
debit and the credit.
Yeah, so if it's at the debit side, it's under provision. If it's at the credit side, it's over provision. So if you see tax provision in your trial balance, and it's at the debit side, it is under provision, but the credit side is over provision. Any other question?
So what about the how do you call it? The increase and decrease in deferred tax. That one to the debit
And
and credit.
so they'll give you the opening balance, then compare with closing balance. That one is a liability, so definitely you see the opening balance will be your trial balance. The closing balance you usually calculate for it. The additional
Okay.
information given the information, then you calculate for it.
Okay.
Then compare. So when compare is an increase, you create the decrease, you also do that. Okay, now let's move on to the next standard, IF21. Rita, can you read for us?
IS 21, the effect of changes in foreign exchange rate. Prepare journal entries to show how the above transactions will be recorded in the booklet and the accrued for the year ended 31st December 2022. Show the financial reporting treatment of the foreign exchange gain award at the 31st December 2024 to Ahiace. Ahiace Limited is one of the leading manufacturers of pharmaceuticals in West Africa. Ahiace has a customer in Mexico called Taco, and he had made a credit sale to Taco on 1st October 2024 for $100,000 Mexico. And he had received first payment on 30th November 2024 of $60,000 MX. The following exchange rates apply during the financial year. 1st October 2024, 1 cedi to $1.25. 30th November 24, 1 cedi to $1.20. 31st December 2024, 1 cedi to $1.10.
Okay, so we will solve this. How do we go about it? Remember, with foreign exchange, the first thing you do is that at the date at which you buy, you need to translate. So we need to check the transaction dates. So at the first day, the transaction date was on 1st October 2024. So we do that on 1st October 2020. Let me check the year again. 2024. We will translate the amount we bought on credit. So we need to find our payables on credit. We bought 100,000. So we check the exchange rate. What's the exchange rate at that date? 1 Ghana cedi to Mexican dollars was 1.25. So yeah, we bring the Mexican dollars, the 1.25 is to Ghana cedi 1. Then we convert the Mexican dollars we had, which was 100,000 here, into Ghana cedi. So in doing that, we bring the Mexican dollars, the 100,000 here. Then we usually do the comparative for that year. So for the Mexican dollars, the comparative here was 1.25. We divide by the comparative, which is a 1.25. Yeah. When we are done, we multiply by 1 Ghana cedi. Do ratio proportion in that regard. So doing our ratio proportion, what will be our answer in Ghana cedi?
8,000.
8,000.
8,000, sorry.
Are you sure?
Yeah, 80.
80,000. Okay. So this is the value when translated into Ghana cedi. Now, in terms of double entry for this, the question said we should do journal. So let me just add that one in addition so that we don't have to come back to that. Bring our dates, we bring particulars or details. And then debits, credits. We bring our currency sign, our functional currency, which is Ghana cedi, Ghana cedi. So 2024, 1st October. So yeah, we check what we bought. Check what did we buy? Yeah, credit sales. We bought pharmaceuticals. So we bought pharmaceutical drugs. So yeah, we'll come here. What are we going to debit? We'll debit our purchases. We bought drugs, so those are classified on your general purchases. We bring our purchases 80,000. Then we are owing. We have not paid. So we are going to record this as payables as well. So under our payable, we have payables here too. 80,000. Then we write our narration for that. Is it Ethel?
Yes, sir. So I want to
Uh-huh.
get this. I'm a bit confused. So Ahiati made a credit sale to Taco. So we are
Uh-huh.
receiving, or shouldn't it be receivables?
Okay, made a credit sales to
Yes.
Tahoe. Okay. Yeah, you're right, you're right. So you are the one receiving. So it's rather credit sales. I was taking it from Tahoe.
Yes, sir.
Okay, the required is saying
Mm.
Ati. Okay, so this is entity referring a financial statement for.
Yes, sir.
Okay. Yeah, you're right, you're right. So I did it for the other way around, for the other entity instead. So yeah, it's going to be between our revenue and then our receivables, right? So we are going to have receivables, right? And then yeah, we'll bring our revenue. Headache. So we have revenue in this case. So thank you, Eto. Then write down narration. So that will be being credit sales to Itaku on 1st October 2024. So that's the first thing we do for the initial date. Then the next one is we'll check whether during the year there was any payment. Remember, on the date of settlement, you need to also translate as well. And then at your year end, you also translate as well. So we need to check whether during the year we made any payment of sorts. So yeah, we said Hattie received. So yeah, we received some payments. So say Hattie received part payment on 30th November 2024 of 60,000 Mexican dollars. So we received 60,000 Mexican dollars. We need to translate this into Ghana city in that case. We need to translate it into Ghana city in that case. But yeah, to translate, we first have to know the equivalent at our initial date. What will be the equivalent of the 60,000? So we need to know the equivalent at the initial date first so that we can compare and get our fair value gain or loss in that case. So the 60,000 yeah, we'll translate using the initial date so that we can get a comparative to compare to get our gain or loss, exchange gain or loss in that case. So when you convert the 60,000 using the initial date, what do we get?
48,000.
We get 48,000. So now we can now convert using the
No, no, it's
settlement date.
50,000, say.
How much do you pay? We paid 60,000. When you
It's
convert,
it's
when you convert,
48.
is it 48? Is it 48
Yeah,
or 50,000?
48 is correct.
It's 48. Then we come to the date that we made the settlement. So the settlement date, then we also translate at that date. So what is the settlement date here? It's 30th November 2024. So 30th November 2024 here. We also translate here. So yeah, look for the exchange rate at this date, which is 1 Ghana cedi Mexican 1.2. So yeah, it's 1.2 at this date. So yeah, let me bring this and then just change to 1.2, right? That was 1.20 at these dates. Let me translate the same $60, $60,000 here using the settlement dates exchange rate. So we do that. The settlement date is 1.2. So when we do that, what are you going to get?
You get 50,000.
50.
50,000. So at the initial date, the value was 48,000. We are going to receive 48, but now at settlement date, we are receiving 50,000. So are we getting an exchange gain or are we getting an exchange loss?
Again.
Again, so look for the difference, which will be an exchange gain. So bear in mind, yeah, we are the one receiving. So we are now receiving 50,000 in this case. Instead of the initial that we're supposed to receive 48,000. So yeah, it's what 2,000. Then we do the adjustment, the double entry for that. So yeah, 2,000 exchange gain. How are we going to record? Which accounts are we going to debit? And which accounts are we going to credit? Which accounts are we going to debit and which account are we going to credit?
Yeah, is it only the exchange gain or all of them?
It's only the exchange gain you are going to account for.
Okay, I
You have
thought
already
this is
accounted. Don't forget, you have already accounted for the initial rate. So it's only the exchange gain
um,
you're accounting for.
but is this one, have they not settled? I thought they've settled.
Ah, okay. So the cash aspect. Yeah, yeah, yeah. So you record the cash
Um,
aspect.
uh-huh.
Yeah. So it will be two. Yeah. Yeah, right. So what will be the double entry? That's what I'm still waiting for. What's the double entry?
So for the cash payment, we'll debit cash
So
and
debit
we'll credit
cash.
receivable.
Credit receivable. The cash, how much do you pay? So we'll do it cash. How much do you
Received.
pay?
Did we
You pay
receive? We are
50,000.
receiving 50,000.
50,000. And then we credit what?
Receivable.
Receivable. But the receivable figure we are owing
It's 48,000.
48,000. We are owing 48,000. So the difference is what will go to.
Yeah, so the exchange gain will credit
So
that
that will go
one.
into P&L, right? The exchange
Yes.
gain, right?
Mm.
So that will be 2,000. Yeah. So that will be being settlement of credit sales on 30th November 2024. Yes, that your hand is up.
Sir, please, I wanted to ask why it's a gain.
Why is
But
again?
I'm looking at it. Yes, I'm looking at it again. Say, it was. I was looking at it from who was. So I think I've seen the answer. Yeah. Thank you.
Esther.
Yes, sir, please. I was look asking why it is a gain.
Yeah, so you're supposed
But
to
I
receive.
realized that initially, we owe we would have received for 48, but because of the exchange rate at the end, we are receiving more. So it's a gain.
Yeah. So that's the reason.
So please, is that it?
Yeah, that's the reason. Okay, then we come to the
Hello.
reporting dates. Yeah, I said that's it. So we come to the reporting date here.
Hello.
We need to find the amount outstanding. So on the reporting date, which is
Yes,
31st
please.
December 2024, we need to find the amount outstanding as at that date. So yeah, we can quickly find the outstanding figure straightforward from what we have done. Let me push this down here a little. So yeah, we can quickly find the outstanding amount, how much we are expected to receive. So outstanding receivable at the initial date, at the translation date, the initial date. Total, we're supposed to receive 80,000 Ghana cedi. They only pay the equivalent of 48 at the initial date. So how much are we supposed to receive? If you are to use the initial date value, you're supposed to use the initial date value.
32,000.
That will be 32,000. Another way to go by this is to look for your foreign currency, the amount outstanding. So beginning was 100,000. We paid 60,000 Mexican dollars. So it's left with 40,000. You can transfer the 40,000 Mexican dollars and you should get the same amount using the same translation date value, you get 32,000 as well. So either you go by this approach or you go by you translating again. Then at this date, we need to translate the amount left. So the amount left, we know the amount left here will be 40,000 Mexican dollars. That's the amount left in Mexican dollars. We need to translate this amount. How do we translate? We need to know the exchange rate at that date. Here is 1.1. So Mexican 1.1 here. We translate the figure. Is equal to this, then we translate the 40,000 here using the 1.1. What do we get?
We're getting 36,000.
36,000.
363.
36,000. There's another one.
yes, 36,363.64.
Oh. 0.6. Yeah, so I was asking a question. Are you going to get an exchange gain or an exchange loss? So then it's going to be an exchange gain, right? We'll be receiving more than what was at the initial date. So that will be 36,363.64 minus 32,000. So what will be our exchange gain in this case?
4,000.
4,000.
363.64. What is it? 63?
64.
Hmm.
That's 0.64. So we showed the exchange gain. It's only going to be the exchange gain. We haven't made any settlements. So we are only going to show the exchange gain at the end of the year. So yeah, we are going to debit receivables with the figure here 4,363.64, and then we debit profit or loss exchange gain with the same figure. And writing exchange gain on the reporting date. Okay, so there is it for that. Questions on it?
Please, what about the remaining amounts we received on that day? It would not pass
It's
any
already
entries.
passed. You already recorded it. You have recorded the opening balance, you have recorded when you paid, and then you recorded the exchange gain, which will increase the receivable figure. So you have already done it. So if you want to look for the
Okay.
closing balance, it's 80,000 minus 48,000 plus 4363. So you don't record that one again. It's because you have already recorded it. There's a chain of recording for that already. Any other? Okay. So we move on to financial instruments in this case. So let's go to I read for us financial instruments.
Okay. Referred. In accordance with IFRS 9, financial instruments, explain how to account for the above transaction in the statement of profit or loss and statement of financial position for the year ended 31st December 2020. Menu Limited is a private company that prepares financial statements in compliance with IFRS. Financial statements for the year ended 31st December 2020 are being prepared and the following transactions occurred. On 1st September 2020, Menu purchased 100,000 ordinary shares on the stock exchange for speculative reasons, that is, making profits at a price of 1.20 pesos per share and paid a transaction cost of 1,250 cedis. On 31st December 2020, the shares were now trading at 1.32 pesos per share on the stock exchange, and mainly received a dividend of 15,000 cedis on the shares.
Okay.
Mainly,
Yeah. Thank you for the I. We'll come to the I. Let's finish the I. So a financial instrument, the first step in answering the question is always to identify the perspective. You have to identify whether we are dealing with the issuer's perspective or the holder perspective. Because for financial instruments here, we always say we have two perspectives here. We have that of the issuer and we have that of holder. So the issuer here, those words that will tell you that we are dealing with the issuer is words that depict buying. So sell, issued, sold, those ones indicate that you are from the issuer's perspective. And then we have the holder's perspective, which are words that depict buying. So you see in the question that you are using words that depict buying. And we are dealing with the holder's perspective. The perspective is important because you know that if it's under the issuer's perspective, we either have a financial liability or you have an equity instrument or you have the two combined in the question, which is compound. You have a compound financial instrument. But if it's at the holder's perspective, you have a financial asset, regardless of the form it takes, whether you buy a financial liability, whether you buy an equity instrument, or whether you buy a compound, you have a financial asset. Though we have several types of financial, you have a financial asset in that case. You can have a financial asset debt and a financial asset equity. But in all cases, you are still holding a financial. So the first step in answering the questions for financial instruments is always to identify the perspective. So let's check for I. What is the perspective? Are we dealing with the issuer's perspective or the holder's perspective?
Holder's perspective.
Yeah, dealing with the holder's perspective. How do you know that is the holder's perspective?
But it says on 1st September, man pitches to buy.
Purchase. So the past event where here is purchase. So you know that we are dealing with the holder's perspective. So under the holder's perspective, we have two main types of financial assets. We have financial asset debt and financial asset equity. So we need to check, are we holding a financial asset debt or we are holding a financial asset equity instrument? So which is which?
Equity.
Equity.
Faustina, your hand is up, right?
Equity. Financial
Yes, we have
asset equity.
equity. How do you know that it was equity?
Okay, so he bought 100,000 ordinary shares.
Ordinary shares. So this is financial assets equity. Equity. That's good. Then the next step is always to identify the method we are using for subsequent measurements. So method of valuation, method of accounting for subsequent measurements. So yeah, which method are we using? You know, we have three methods. Either you're using the amortized cost, you're using fair value through profit or loss, or fair value through OCI.
We use fair value through profit or loss.
Yeah, whose hand is up?
Fair value through profit and loss.
So your hand is not up. Okay, so fair value through profit or loss. So Bosuhine is saying it's fair value through profit or loss. How did you know that it was fair value through profit or loss? Bosuhine, how did you know?
He bought it purposely to make profit for speculation money, so that
Profit.
when the price goes up, you earn profit.
For speculative reasons, so that he makes profit. Do you all agree with him? Do you all agree with him? Hello, do you all agree with Bosuhine?
Yes, sir, we
Yes, sir.
agree.
You all agree? Okay. So yeah, the intention is to make profit, right? Yeah, holding to make profit. So yeah, we are going to use the give me a minute. Yeah, so if you are holding for speculative reasons, the same as you holding for trading purposes. Maybe. Give me about 5 minutes. Let me attend to something. I'll be back. Yeah, sorry, I'm back. Yeah, so we knew the method we are using the fair value through profit or loss because it's for speculative reasons. So we'll go straight into the initial measurements for that. We are doing question 1I. We are doing question 1I. So yeah, we need to calculate for the initial value. How do we get the initial value on the financial assets? So you know that here, to get the initial value here, if you are using fair value through profit or loss, it will just be your fair value. If you have transaction costs, you expense it. So check in this question. Were we having transaction costs? Yeah, we had a transaction cost here of 1250. So that will be expensed in our profit or loss. But first, we need to get our fair value. How do we get fair value for shares? For shares, you need to bring the price per share and then multiply by the quantities of shares. So yeah, to get our fair value here, basically bring the price and multiply by the quantity. So the initial value here will be the price per share. The initial it was 1.2. So 1.2 here. Multiply by the quantities of shares, which is 100,000. What do we get as our answer?
Mm-hmm. 120,000.
So 120,000. Then we come to subsequent year. So that's a year end on 31st December. So on 31st December, yeah, you need to find for the fair value again and then compare and see whether we have a fair value gain or a fair value loss. So the value here will be the same price times quantity. So the price this time around is 1.32. So 1.32 multiplied by 100,000 shares. Our resultant answer will be 132,000. Then we compare to get our fair value gain or fair value loss. So yeah, we're going to get a gain or are going to get a loss? Yeah, is the gain is up? Are you getting a gain or a loss?
Sir, please, it's a question. It seems there's a transaction cost, or there's no transaction. We don't deduct the transaction cost.
Why you did that? You don't need that. And even here we are
Um,
doing financial assets. Financial assets,
okay.
but we don't really need that transaction cost. And we are using fair value through profit or loss. So fair value through profit or loss, transaction cost is expense.
Okay, yeah.
It's expense. So we don't have to come and add it to over here. Okay. So yeah, I thought you were coming to answer my gain or loss question. Are you getting a gain or are you getting a loss?
We are getting a gain.
I'm getting a gain. So we look for the difference. That will be again 132,000 minus 120,000. What are you getting?
12,000.
12,000.
12,000. Then we report this. So but don't forget that we have a dividend also here. We report that when we are doing the extract. So we prepare an extract for this. Name of entity is Manu Limited. Statement of profit or loss for the year ended 31st December 2020. So yeah, we report a fair value gain of 12,000. Then yeah, we have a dividend received. We receive a dividend. And this is a finance income, right? So dividend received is a finance income. That's our dividend received. Yeah. Receive a dividend of 15,000. We report that here. Then we come to position. Statement of financial position. As at 31st December 2020. So non-current it's a current assets. It's for just a year. When it's for speculative reasons, it's just for a year. So bring that financial assets here. We bring our closing balance, which is 132. That one. Yeah, Abby, your hand is up.
Yes, sir. Please, I wanted to find out. I realized the date it was fair valued was no, the date it was bought was 1st September.
Yes.
1st September. So I want to find out, and our reporting date is 30th December. So I want to find out if the date will not affect it.
Oh, no. The
Okay.
date is even affirming the fact that it's for speculative reasons, for short-term purpose. So it will affect that.
Okay.
And it's shares can be bought. Shares can be bought anytime, and the date doesn't affect your fair value gain or loss.
Oh, okay. Okay. Thank you.
So our transaction cost here is 1250. I report at 1250. So this will be our extract that we need to report for this question for the I. Any question on this? According to II. Yeah, that's all.
Yes, sir. So, are we neglecting the transaction cost in the statement of profits and loss?
I've recorded it here. Have you seen it?
Okay, I'm not seeing it. I think my screen. Let me log off and then log back on.
Okay. So let's go to II. I read II.
II. Menu issued 360,000 of redeemable 2% preference shares at a discount of 14% on 1st January 2020. Issue costs were 5,465 Ghana cedis. The shares will be redeemed on 31st December 2022 at par. Interest is paid annually in arrears, and the effective interest rate is 8%. In accordance with
8%.
yeah,
Okay, you can proceed.
in accordance with IFRS 9, explain how to account for the above transaction in the statement of profit or loss and statement of financial position.
Okay. Okay, thank you. So how do we go about this? First thing is perspective. Which perspective are we reading? Are we reading the issuer's perspective or the holder's perspective?
Issuer.
Issuer. How do you know it was issuer?
Because Manu issued.
Issued. Okay. Then issuer, we have three types of instruments. Either it's a financial liability, an equity instrument, or a compound financial instrument. What type do we have over here? Isaac.
Financial liability.
Isaac, why do we say financial liability? Let's try seeing shares.
Because it's a redeemable preference share.
That's good because it's redeemable preference share. Continue.
And redeemable preference shares under IFRS 9 are liabilities.
Liabilities. Yeah, because of the presence of obligation they carry, right? So you're right, yeah. It's a financial liability here because of the presence of obligations they carry. So you are going to treat it as a financial liability. And for financial liability, we have two measurement models for also that one. Either you're using the amortized cost or you're using fair value through profit or loss. So which is which for our case? Are we using amortized cost or are we using fair value through profit or loss? Okay, ethos says it's amortized cost in the comment section. Yes, it's amortized cost. Once you see effective interest rate, it means you need to do some form of amortization. So we'll use the amortized cost in this case. So yeah, we'll start with the initial value. How do we get the initial value over here? It is fair value less transaction cost or financial liability. If you are using amortized cost to be a fair value less a transaction cost. So yeah, first we need to get our fair value in this question. How do we get a fair value in this question? Yeah, we have the nominal value of the instrument to be 360,000, and there is a discount over here of 14%. So, once there's a discount, you need to less the discount to get a fair value. So we need to less our discount here to get a fair value. So the nominal value here that we have 360,000. We'll less the discount aspect, which is 14% on 360,000. Let's punch out on the calculator. What will be your fair value? Final answer, what will be your fair value?
309,600.
309,600. So this will be our fair value in this case. Okay, then the next thing you do is you do our subsequent measurements. In subsequent measurement, we need to amortize. So we'll bring our year. We'll bring our opening financial assets. We'll bring our finance income at the effective interest rate, which was given to us here as 8%. 8% here. Bring our cash received. Then we get closing financial assets. Then we check in the question, how many years is the question demanding us to prepare for? This was issued on 1st January 2020. And then it will be redeemed on 31st December 2022. So what's the period of the instrument in itself? What's the period of the instrument? Yeah, Isaac, you answer.
Sir, it's a liability. I think you made it asset or something.
Liability. Oh, yeah, I read it. Yeah, it's a liability. So opening financial liability. Then this will be finance costs. Okay, thank you for alerting me to do that correction. So it's a liability. Okay. Yeah, right, it's a liability. So bring opening financial liability in that case. Yeah, we have not even less the transaction cost. Let me manage the initial value here. So the fair value was 309,600. Or less the transaction costs. What is the transaction cost? We're giving issue cost as 5,264,65. So 5,265. We less that to get the initial value. So what will be our answer? Our final figure.
$304,000.
304,000. 335. So this becomes the initial value in this case. So I was talking about the period. What's the period of the instrument? The instrument was issued on 1st January 2020, and then it will be redeemed on 31st December 2022. How many years is that?
3 years.
That's 3 years. Yeah, exactly. That would be 3 years. But we have to check in our required. How many years is the required demand us to prepare for? So we checking the required year reporting for 31st December 2020. And how many years would that be? Would that be 1 year, 2 years, 3 years?
1 year.
That would just be 1 year. So we are preparing for just the 2020 year. We bring out opening balance, yeah, which is a 304,335. We calculate for our finance cost, which is 8% on the value. And then we get our cash paid. We get our cash paid. So how do we get a cash paid for the first year? How do we get it? So your cash paid should always be your coupon amount. And how do we get coupon amount? You say coupon amount, yeah, is the rate attached to your instrument. So you calculate the rate attached to our instrument here is 2%. You calculate this 2% always on your nominal value. But the coupon amount is always fixed. So you calculate it on your nominal value. So 2% on 360,000. What are we going to get?
7,200.
7,200. Then we calculate for the closing balance by summing all. So this becomes our closing financial liability. Then you do your presentation in that regard. Name of the entity will come still Menu Limited. Current statement of profit or loss. Here. Here we are going to report our finance cost, which is the 24. I'll show you that's negative. Then we come to statements of financial position. We report non-current assets, financial assets. So this will be answer for this question. If there are questions on this, I'll take it. This financial liability, what am I doing with assets?
Hello.
Yes. Who is speaking? Yeah, who is speaking? Okay. Is there any question? Okay, there's no question. Move on to our next question. Question 2, yeah? I'll read up issue for us.
On 1st April 2017, a pre purchased 500,000 shares in a key supplier, Mensa Limited. The shares were purchased in order to protect a 3-year source of supply, and Mensa has no intention of trading these shares. The shares cost 2 cedi per share. The direct cost of purchasing the shares were 100,000 cedis. On 1st January 2018, the supplier paid dividend of 0.30 per share. On 31st March 2018, the fair value of a share in Mensa Limited was 2.25 Ghana cedis. Required. How will this financial instrument appear in the financial statement for the year ending 31st March 2018 and 2019?
2019. So first thing you know, for financial instrument is perspective. So which perspective are we dealing with? Are we dealing with the issuer's perspective or the holder's perspective?
Holder's perspective.
Yeah, how do you know that we're dealing with the holder's perspective?
Because the free purchased.
A 3-year purchase. And then when we come to the requirements here, they didn't mention a 3-year. You can see here we have two entities here. A 3-year and Mensa, right? So it means a 3-year here is a holder and Mensa here is the issuer. If they're required, told us that we are preparing the statement for Mensa, then it means that you have used the issuer's perspective. But since it's silent, we always assume the first entity is what we are preparing for. So we prepare in line with a 3-year, and that is that. And then we need to determine what type of financial asset is this. Is it a financial asset debt or financial asset equity?
Equity.
And this will be a financial asset equity because of the shares, right?
Yes.
And the next thing we determine is you determine the method we are using here. Are you using fair value through profit or loss or fair value through OCI?
Fair value through OCI.
How do you know that you're supposed to use fair value through OCI?
Because Mensa has no intention of trading these shares. So
Yeah, so yeah, the measurement rules, is two. It's either fair value through profit or loss or fair value through OCI. So if Mensa has no intention of trading in these shares, then it means it's not for trading purpose. It means to just be for the other purpose, which is for OCI. So yeah, we are going to use OCI in that
yeah.
regard. Yes, please.
The question again. The question.
The question again. As now,
No, I want to look at the question. I want to ask. So they said Mensa has no intention of trading these shares. Doesn't mean that he's not willing to sell to free. I'm confused.
the reason they brought that clause is for you to know the method. It's not what you're thinking about.
No, I was thinking maybe it would have been a free year has no intention of trading, so that we'll know that it is a free. I don't know.
Does it matter? Yeah, is that the year I'm going? Right. Your hand is up.
Hello, sir.
Yeah.
Sir, please, what takes in the question? What takes the amortization person, the
Is
amortized
that
cost out? Like whether to know you are fair value through amortized cost or OCI and um ENL. Like this one, you just mentioned only OCI and PNL,
uh,
but I didn't
yeah,
say
it's
anything
OCI,
about the
it's
amortized cost.
OCI,
So
it's
what?
OCI and PNL. It's OCI and PNL. It's just OCI and PNL. Financial asset equity is measured using two measurement rules. It's just fair value through profit or loss
Oh,
and fair
okay.
value through OCI.
Okay.
Yeah, so financial assets equity is measured using only two. It's only fair value through OCI, fair value through profit or loss. So we don't have anything like amortized cost over there. Maybe you should look at the rules in that regard. We realize you don't have anything as amortized cost under fair value equity. You don't have anything like that. Okay, let's make progress. We have a lot to finish up. So yeah, it will be fair value here. Then you add your transaction cost. Remember, if you're using OCI, you add transaction cost in this case. So yeah, we need to calculate for our fair value. How do we get fair value? We know the number of shares here to be 500,000. Multiply by the price per share. And we're given a price per share here to be 2 Ghana cedis. So we calculate for the fair value here, which is price times quantity. The price here was 2. The quantities of shares is 500,000. What will be our resultant answer here? 1 million, right? Then we have our transaction costs given to us already. So we bring our initial value here, which is going to be 1 million. And we'll add our transaction cost, which is 100,000. So that will be 1.1 million over here. So this is our initial value. Then what's the next thing we do? So we just have to look at the value at the end of the year. So here we are reporting on two dates, 31st March 2018 and that of 2019. So we need to check the values we were given. Yeah, we're only giving the closing balance for 2018. They didn't even give us that for 2019. Yeah, we're only giving that of 2018. This is the price now. So on 31st March 2018, yeah, we calculate for the fair value again, which will be our price is what 2.25 times 500,000. Let's multiply that. 2.25 times 500,000. What do you get?
1,125,000.
1,125,000. Then we compare to see if you are getting a gain or you're getting a loss. So here we compare, are we getting a gain or are getting a loss? So you can clearly see that we're getting a gain, right? Which is 1,125,000 minus 1.1 in this case. We less than we get 25,000. We get 25. So here's the fair value gain. So on 31st March 2019, they didn't give us information on that, so we don't even have to bother our head with that. We'll only focus with the 2018 and then repair our extracts in that regard. So your name of entity will come, you're praying for a free year. Statement of profit or loss. 31st March, yeah, 2018. We'll bring our fair value gain here. Of 25,000. And we check whether during the year we receive dividend. Do we receive dividend within a year? We're told that on 1st January 2019, we had a dividend of 0.3 pesos. So we need to include the dividend. The dividend is our finance income. Yeah. So let me do the calculation here in bracket here. That was 0.30. Multiply by the quantities of shares. The quantities of shares is 500,000. So what do we get? 0.30 times 500,000.
150,000.
150,000. Then we just go to statement of financial position. Yeah, I can do for 2018 and 2019. And bring the balances. It will be the same balances though, because 2019 we're not giving any information on that. So this will be a current asset. Financial assets. The value we had is 1,125,000. So that's that in this question. Any question on this? Any question on this? If there's no question, move on to the next leases. For those with our tuition center, already leases not long ago. So I just brought one question there to refresh our mind on that. So leases, can you read that? Arida, please continue. Leases.
IFRS 16 leasing. Google Limited operates in the automobile industry. The following transaction relates to Google for the year ended 31st July 2023. On 1st August 2022, Google entered into a 10-year lease, agreeing to pay 3 million cedis annually in arrears in exchange for the use of a building. The present value of the minimum lease payment was 20.13 million Ghana cedis at 1st August 2022, and the useful economic life of the building was 50 years. Google's cost of capital is 8%. In accordance with IFRS 16 leases, show the financial reporting treatment of the above transactions in the financial statements of Google for the year ending 31st July 2023.
Okay. Thank you. So with leases here, you can see clearly that this one is on leasehold accounting, and we got leasehold. This is on leasee accounting, and with leasee accounting, we say an initial date. You need to determine the initial value of the lease and then the right of use of assets. So yeah, first step is we need to get the initial value of our lease liability. And I told you that with the initial value of your lease liability, yeah, to get that, is either the question gives you the value straightforward or you have to calculate for that. So let's check here whether we're given or we have to calculate for it. And we said to get that one is the present value of your lease payment, not yet paid. So you can clearly see that here we're given. Let's say yes, present value of our minimum lease payment was this. So yeah, that's already been calculated for you already. So yeah, 20.13 million. That's already been given to us already. So yeah, we have the initial value of our lease liability. Next we go is initial value of our right of use of assets. We need to get the initial value of our right of use of assets. And we said the first step to get your initial value of a right of use of assets is to bring your initial value of your lease liability. So that's the first thing, right? The value you had for your lease liability. You bring that. Which is 20.13. Then say you check if you have any initial deposit or payment in advance. Was there any payment made before or at the commencement date? Can clearly see that, yeah, we don't have any payment like that. You also check if you have initial direct costs. And we don't have that. And lastly, check for dismantling or removal costs. And we also don't have that yet. So this will still be our initial value of our lease liability. So once we get the initial value of the lease liability, for the right of use of assets, we need to calculate for depreciation in this case. So depreciation will be the 20.13 million. Then we divide by the lower of the standard always says you use the lower of the useful life of the assets. So let's check the useful life of the assets. The useful life, economic life of the asset was 50 years. And then we compare that with our lease term. Our lease term to is here is 10-year lease. So we check which one is lesser, which one is lower. 50 and 10, which one is lower?
10.
10, definitely the 10 is lower. So you're going to use the 10 to calculate for your depreciation. Calculate for your depreciation. Then we check the period involved too. The contract was signed on 1st August 2022, and we are reporting at 31st July 2022. 2023. How many years is that? How many years is that? That's a year off.
1 year.
1 year.
Yeah, that's a year. So we are praying for just 1 year. So let's calculate for that. Depreciation here will be what? Is it 2.013? So yeah, 2 decimal place. So 0.1. Let me do it in 2 decimal place. Then you calculate for the current amount in this case. So this becomes the current amount as at the year end. So this is the initial value of our right of use of assets in this case. And the next thing it comes is the lease liability. We do the subsequent measurements for our lease liability. And then the subsequent measurement, you need to check whether it's payment in arrears or payment in advance, because you know the amortization schedule is dependent on that. So let's check, is it payment in arrears or payment in advance?
In arrears.
In arrears. So we'll do that. So bring opening balance. Finance cost at the rate, which is 8% in this case. And then you bring your lease payment. Then you get a closing balance. So that will be for that. And here we are going to prepare for 2 years. The question is, we are preparing for only 1 year, but you know that for lease it's separate between current and non-current. You have to add the next year's onto it. So you do that for 2 years. So opening balance here is 20 points for the lease liability. We have 20.13. We recorded that here. We'll bring that there. We calculate for our finance costs on that. Then we bring our lease payments. So our lease payment here was 3 million. We're paying 3 million annually. So 3 million. And then we calculate for the closing in this case. Closing becomes opening. It's supposed to be 3. Then we are done with separating it between current and non-current. So let me do the non-current liability aspect first. Non-current liability for your lease always for year 1. So you pick the second year's closing, that becomes your non-current liability value. And that one will take more than 1 year to pay. So that's 17.24 million. Then for the current liability here, we have 2 ways of going about it. I only do one. We look for the differences between the closing balances for year 1 and year 2. So year 1 is 18.74 million. Then less that of 17.24 million. What are you going to get? 1 point what? 1.5? Oh,
Yeah, 1.5.
okay. Then we do the presentation here. Name of entity will come first. So Fugu Limited. Statement of profit or loss. That's 1st July. So yeah, we bring our finance costs. Yeah, record non-current liability. Financial liability. So yeah, I've done a separation here. Non-current is 17.24, and then current liability. Current liability is 1.5. Yeah, this is for the leases. Questions on the lease? Okay, so this is how you go about IFRS 16 when you have the lease accounting. Let's go to the next time, that borrowing costs. Borrowing costs as well. Yeah, Rita, let's go ahead. Borrowing costs.
1. 𝐷𝐷 Limited incurred the following borrowing costs during the financial year 2019. Overdraft interest, foreign currency loan interest, that's correctly translated into Ghana cedi. Foreign currency loan exchange difference on capital. In addition, a 3-year fixed rate of 2 million cedis loan was taken out 1st January 2019 at 6.5%. A loan setup fee was charged at 20,000 cedis. This increased the effective interest rate on the loan to 6.88%. Required: determine the maximum amount that could potentially be capitalized as borrowing costs during the period, assuming an asset was being financed using all available finance.
Okay. Assuming you are using all available finance. So this borrowing cost, we need to determine whether we are going to consider that as borrowing cost to capitalize or not. The first, you have overdraft interest. If you use overdraft for your qualifying asset, definitely overdraft interest will be part of your borrowing cost to capitalize. Second, we have foreign currency loan interest. So if you borrow an amount of money outside to finance a qualifying asset, the interest on it too, yeah, will be considered. The next we have is foreign exchange loan exchange difference on capital. Should we consider the exchange difference on the capital? Should we consider that? No, we are not going to consider this. Reason being that this is a foreign exchange difference on capital. Give me a minute. Yeah, sorry for that. So I was talking about the foreign currency loan exchange differences on the capital. That one is not going to consider because this one is even on capital, not on loan. But anyhow, the only foreign exchange difference you consider is if it relates to a loan interest in that regard, you're going to consider that. But this doesn't even relate to that. Then we have another one over here saying that in addition to the 3-year fixed rate, 2 million loan was also taken out on 1st January 2019 at the rate of 6.5. A loan setup fee was 20,000, and this increased the effective interest rate to 6.88. So yeah, my first question will be, which rate are we going to use? Are we going to use the 6.5% to calculate for the interest, or we are going to use the 6.88? Which are you going to use? Hello, which one are you going to use? Are you going to use the 6.5 or the 6.88?
The 6.88.
Why 6.88? That's the effective interest rate. So that's what you're supposed to use. That's the answer. That's the effective interest rate. So you use that instead. Use that instead. But yeah, remember we have a processing fee here. So we have a processing fee in this question. So what are you going to do with the processing fee? Yeah, when you're going to calculate for the borrowing cost here, we need to less it from the value of the loan so that we can get the value of the loan only. So yeah, in calculating for that, we'll bring the value 2 million here, then we less the 20,000 in that regard before applying the rates, the 6.88. So that's how we go about that. So let me do that here. Today's IAS 23. So yeah, we said we bring overdraft interest. So bring our overdraft interest of 12. Then we have the foreign exchange, the foreign currency, loan interest, which is 84. Then next we'll do for the other one as well, the loan that we went for. So we'll calculate for the loan interest here too. In doing this, say first you need to find the difference between the 2 million and then the 20,000. Yeah, we have 3 zeros on top. So 2 million will be 2,000. And then the 20,000 become 20 in this case, before we multiply by the effective interest rate, which is 6.88%. So let's do that. What is going to be our loan interest?
$1,998.624.
Three zeros on top. Are you sure the figure you're getting?
136.22.
136.22. Then we sum them together. This plus this plus this. This becomes our borrowing cost to capitalize. And we are done with that. Okay, then move on to question number 2. So if there's a question on this, let me know before we go to question 2.
Sir, I'm confused. I'm confused
Yeah,
as to why we are using the 6.88.
effective interest rates.
Yes,
That's the reason.
the increase to the 6.88 is as a result of the charge, the 20,000 charge, processing fee, which is not to be capitalized. And so since it's not being
Which is
capitalized,
not to be.
which is not supposed to be, is not to be capitalized, right? Oh,
It's not to be capitalized. Who says so? Yeah, so whenever you're giving two interest rates, you just go for the effective. Don't make it out on yourself. Whenever you're giving two interest rates, you just go for the effective interest rates.
okay.
Okay, let's go to our question 2.
Question 2. Malcolm Construction has 3 sources of borrowing: a 7-year loan, a 10-year loan, and a bank overdraft. The 7-year loan has been specifically raised to fund the building of a qualifying asset. Malcolm Construction has incurred the following expenditure on a project funded from general borrowing for the year 31st December 2021. Date incurred and amount: 31st March 1 million, 31st July 1.2, 30th October 800,000. Calculate the amount to be capitalized.
Okay, thank you, Rita. So borrowing costs, we need to determine whether this relates to specific borrowing or general borrowing. Yeah, we having specific borrowing or having general borrowing.
And the 7-year is specific. And
7-year specific, right?
Yes.
Okay. So if 7-year specific, means the rest is for the general. So yeah, we have two. We have both specific and general. And in questions in which you have both specific and general, you first have to calculate for borrowing costs for them, each of them separately. When you're done, you add all the two together. So we need to do that for the specific one separately and do that for general one separately before adding the two. So yeah, calculate for borrowing costs. Let me start with a specific borrowing. So specific borrowing, first thing is formula. How do we get specific borrowing? Bring your actual borrowing cost incurred. Then you less your investment income. So yeah, the 7-year loan, we have been given the interest here to be 800,000. We'll bring that 800,000. Let's see whether in this question we have investments. Were we given an investment income percentage for us to calculate? No, we're not given. So investment income here is 0. So yeah, our borrowing cost here will still be 8,000 for the specific borrowing. Then we go to general borrowings. Yeah, Ethel, let me finish before you come in. So for the general borrowings here, we are using that of a 10-year loan and that of a bank overdraft. Yeah. But we should take note of the period involved. Take note of the period involved for that. So yeah, the ideal thing was for us to calculate for the capitalization rates, right? So that's the first thing you do for general borrowings. That's one of the key things you have to do. You need to calculate for capitalization rates. And how do we get capitalization rates? Your total interest divided by total loans, then times 100. So capitalization rate here was, the capitalization rate here will be your total interest. And here the total interest here, we have two interests in this case. We have 900,000 and 900,000. These are for the general borrowings. So add the two together, that will give us 1.8, right? So you have 1.8 million. Then you divide their total loan value. So that's 10 million and 5 million. So that will be 50 million. Then you multiply by 100. What's going to be our capitalization rate?
12%.
What?
12%.
12%. Exactly 12%?
Yes.
Okay. So 12% in that case. Then we calculate for the borrowing cost in this case. And to get borrowing cost here, the formula for borrowing cost to capitalize here will be the funds used for the qualifying assets. And then multiply by the capitalization rate we had. Then consider the period involved. So M/12. Consider the period involved as well. So we'll start with the first one. Yeah. They've given us the pattern of the amount of money, how we use or how we spend the amount of money. They said Mafu Femme or Femo construction has incurred the following expenditure for the period from the general borrowings. The reason why we are only basing for this for the general, because the question said that this is for only the general borrowings. So the general borrowings have been as how we use the amount. So we use 1,000 Ghana Cedi on 31st March. So meaning that interest will accrue on that amount of money from 31st March to the end of the year. That's 31st December. We need to determine the number of months here from March to December. How many months is that?
9 months.
How many months is that? 9 months. So we bring that there. That's 9 months. So 9 months, we calculate for the interest in this case. How do we get the interest? We know about percentage here, capitalization rate to be 12%. We multiply it on the amount we use, which is 1 million. Then we consider the number of months involved. This is 9/12. So let's calculate for that. 12% of 1 million times 9/12. What are we getting here?
81,000.
81,000. Then move on to the next one. That's from 31st July to 31st July to 31st December. How many months is that?
5 months.
5 months. Do you agree? So it will be 12% on the amount we use for that period is 1.2 billion times 5/12. So let's calculate for that.
60,000.
60,000. Then move on to the next one, which is 30th of October. To 31st December. How many months is that?
2 months.
2 months. So that will be 12% of 800,000 times the number of months. 2/12.
16,000.
Right. 60,000.
16.
16.
Yes.
Okay. We sum this together. And we calculate for our total borrowing cost. We bring that from the specific borrowing. We add 800,000. And then we add the general borrowing, which is 157,000. So yeah, we're going to get 957,000. So we are done. If there are questions, I think Ethel, your hand was up in here.
Yes, so the first one I was overthinking, so I got sorted. But then the second one, I want us to look at the 31st March calculation again. Is it supposed to be 81,000? Because I got, was it 90,000 or so?
Yeah, so please check if the calculation is correct. So the first one, right? And a general borrowing, the first one, right?
Yes, sir.
Yeah, please let's check. Is it correct? You guys give
It's
me a correct figure.
90,000.
It's 90,000, rather.
Yes, please.
Yeah.
Okay.
Yes, sir. And then the first one where I was overthinking was that I thought so we were supposed to neglect the 7-year loan because under the borrowing costs we don't we exclude qualifying assets. So I think I was just
You exclude,
overthinking
you,
that, but
you
I saw
exclude
that.
qualifying assets.
Pardon?
You say you exclude qualifying assets.
Yes, please. Under the borrowing cost.
We exclude qualifying assets.
That's what I'm thinking. I think so.
I don't know whether you're saying it for or you're not saying it. We don't exclude qualifying. We do it for qualifying assets.
The
The thing is that
exclusions
the
of
thing is if you are doing for general borrowing, you exclude specific borrowing. So that's what I'm saying. You should say it well. So when you're doing general borrowing, you don't bring specific. That's why I said you have to do it separately.
Yes,
So
sir.
because you can see that when we're doing a capitalization rate, we didn't bring anything specific. We only did that for the general.
Yes, sir.
So whenever you're doing general borrowings, you must not include anything specific borrowing inside. Yeah. So I think that was what you wanted to say.
Yes, sir. Yeah. Thank you.
Okay. You're welcome. Oh, I think so we are done with the borrowing costs. So these are usually the nature of the questions you come. You may have a question having both the specific and then the general. Next we have is government grants. Yeah. So let's look at government grants as well. I read that government grants. Is Arida around or she's tired? You can get a different reader. Can we get someone else to read for us? Yeah, Isaac, go ahead.
Okay. Government grants. 1. Success Limited, a manufacturer and supplier of cashew products, has recently established a new facility in Cape Coast. To help in this new operation, Success Limited has secured support from the government of Ghana and is unsure how the grants are to be accounted for in the financial statements. The company has a year end of 30th April 2021, and the following transactions took place on 1st May 2020. A grant of 150,000 Ghana cedis was paid to a company to allow it to settle its outstanding accounts payable, and prevent it from going into liquidation.
Okay, so Isaac, read the required for us and let's take it 1-1.
Required.
Read the required for us.
Explain how each of the above should be accounted for in the financial statements of Success Limited for the year ended 30th April 2021 in accordance with IS 20, Accounting for Government Grants and Disclosure of Government Assistance.
Okay. So let's take I again.
A grant of 150,000 Ghana cedis was paid to a company to allow it to settle its outstanding accounts payable and prevent it from going into liquidation.
Okay, so yeah, how are you going to account for this? This one you're just supposed to write your answer. I'm supposed to write your answer. So maybe let me do a recap on grants, government grants. So for government grants, we have two types. We have grants for assets, and then we have grants for expenditure. In most books, you see it as grants related to income. So grant related to income is the same as a grant that has been assigned for an expenditure item. A grant related to an asset is a grant you are giving specifically for that assets. Now, if it's for expenditure, it's for two ways. It's either you are doing it for past costs or you are doing it for current and future costs. So current and future cost. So you always have to check for the expenditure. Is it for current year cost or is it for past costs or is it for current or future year? If it's past costs, we say immediately record the whole amount in profit or loss. If it's for past costs, since the event has already occurred in the past, you record it immediately in profit or loss. But for the current and future year, you only deal with your current year. You only account for, you amortize and account for the part that relates to only the current year for that. The part that relates to the current year, you take it to profit or loss. And then the other ones, you wait till the future years to account for them. So this is just a little overview on that. And we say that whenever you see a government assistance, that one you disclose it. So it's either you're looking for grants or you're looking for government assistance. So I'll start with do we have a grant or we have a government assistance? That's the first thing you need to always check. Whether we are dealing with government grants or we are dealing with government assistance. So are we having government grants or are we having government assistance? So with the I. Hello. Yeah, Eto.
Say government grants.
Government grants. Government grant. Why? Thank you, but why?
Please, can I help?
Yeah, go ahead, Laurie.
Yeah, why? Because the sum or the amount given can be quantified in monetary terms.
Quantify in monetary terms. Is that all?
And it was given by the government to aid them or
Yeah,
to finance their
so yes,
project.
so it's given for an expenditure to aid them in a specific expenditure, right? So that will lead me to whether it was for assets or for an expenditure, whether it's grant related to assets or grant related to expenditure, that's income. So yeah, you can clearly see that there's a grant that relates to expenditure, right? It's not an asset in this case. It's related to an expenditure. It's related to an expenditure. It's not related to an asset. You can see, say 150 was paid to a company to allow it settle its outstanding account payable and prevent it from going to liquidation. So this is specifically for an expenditure line. So you can say this is a grant related to income. They gave you an income to cater for your expenditure line. Then the only thing you have to worry your head is to know the treatment. But I'm sure the question also asks us for the treatment. So to know the treatment, you're supposed to ask yourself whether it's for past costs or for current and future costs. So we check. Was this 150,000 they gave to you? Was the expenditure for a past? Was the expenditure in the past? Or this expenditure that we are now going to incur for future and subsequent year? They are going to incur current and for subsequent year. We need to ascertain that. So which is which? Is it past cost or for current and future?
Current and future.
Are you sure?
So, outstanding. Past cost.
Outstanding loan.
Okay.
So that's past cost. And if it's past cost, the whole amount will be recorded in profit or loss. You record everything in profit or loss. So that's what you just talk about. So you first tell us that it's a grant. That's the first thing. Then tell us the type of grant it is. Is that it's a grant related to an income. Then tell us that the treatment for it, that you are going to record the whole 150,000 since it relates to a past cost. So you tell us in that regard, and you get a full marks for that. So that's for I. I. Reader, please go with I for us.
I. A grant of 50% tax relief, the net effect of which is estimated at 85,000 Ghana cedis per annum. For establishing a manufacturing company in the area was to provide employment for the youth.
Okay, so this is it a government grant or a government assistance?
A government grant.
Why?
Because it can be quantified in monetary terms, and then it is also to settle.
I'm coming. We don't use quantification in monetary terms
He
to
said,
justify for that.
No,
But what
sir.
else? What else? We were saying something else.
yeah, I was saying it is to settle an expense.
To settle on expense. Okay. That's your thought. Ethel, you want to go ahead?
Say, I know IAS 20 does not take into consideration tax, so we have to treat it under IAS 12 instead of IAS 20. So I don't think we would have to treat this at all.
So what's your answer?
So my
Government
answer is we don't treat the tax.
Simple. Is it a government grant or
No,
it's a government assistance? That's my
assistance.
answer.
Yes, so it will be in assistance. Yeah.
Why is it an assistance? Why is it an assistance?
And say because the government assistance is just any action of the government that aims at giving you an economic benefit. So that's what I'm looking at from this point. I don't know if I'm right.
Yeah, so the government, as you said, the definition for it is the actions of the government that gives you some form of benefits, right? So some form of support. So this is the government that gives you some form of support. Okay, big man, your hand is up. Let me hear from you too.
All right, so I will also contribute that is government assistance. Since the government is granting us a tax relief of 50%, so equally it's an action of government to relieve us for establishing manufacturing company in that particular area. Thank
you. Okay, so you're all right. It's the government assistance. Yeah, tax relief is a government assistance. That the government gives to support businesses. You support business. And here you can see there's no the government is not giving you a direct money. So the one was trying to use a quantification aspect. The government is not giving you money here. He's just giving you an assistance here. But the tax you're supposed to pay, giving you a relief of it. That you only pay 50%. And if you get 50% relief. So yeah, it's not necessarily giving you money directly in that case. Okay, so yes, government assistance. And for government assistance, what do you do? When you check the name of the standard, we disclose government assistance. So it says accounting for government grants and disclosure of government assistance. So for government assistance, you just disclose. So this is the two things you mentioned. You mentioned that it's a government assistance. And you mentioned also that the accounting of it, you are going to disclose it in the notes of the account. So that's if you are done with II. We move on to III.
III. Success Limited receives a grant of 300,000 Ghana cedis towards the acquisition of a machine costing 500,000 Ghana cedis. The machine has a useful life of 5 years.
Okay, so is this a grant or is it a government assistance?
Okay,
It's a
so
grant.
Yeah, big man, your hand is up. Go ahead.
Yes, sir. So please, this is a government grant towards the acquisition of a machine or a non-current asset.
Okay, so this is a grant related to an asset. It's a grant related to an asset. Okay, let me talk about the rules for that. Then we solve that part. So if it's grants related to an asset, we have two types, or let me say two approaches to answering the question. We have either you're using the deferred income approach, and with the deferred income approach here, what you are doing is you're recording the income separately from the assets. You are recording the income separately from the assets. So with a deferred income approach here, the only thing you're supposed to do is that you're supposed to amortize the grant you have over the useful life of the asset. Since it's given for an asset, you just divide the grants you have over the useful life of the assets so that you can know the amount of money you're going to record in profit or loss for each year. And then we have the net off approach. So with the net off approach, you are going to subtract the grants from the cost of the assets. So at the initial days, once you have a grant here, you just subtract it from the cost of the assets, then calculate for your depreciation on the remainder figure you have. The figure that is left after the subtraction of the grants, you calculate your depreciation on it, and then you account for your depreciation in profit or loss. You are done with that. So these are the two approaches we have. Yeah, we'll solve for all the two approaches so that we have a comprehensive. Yeah. So here we have a government grant related to an asset. Why is it related to an asset? Acquisition of what? Machine. Yeah. So let me start with the deferred income approach for this question. So remember with the deferred income approach, the accounting for the government grant separately from what? The assets. So when we come to the grants, for instance, here, we need to get a grant for each year. So we need to get grants for each year. And how are you going to do that? You bring up the total grants you have, which is 300,000 here, and then you divide by the useful life of the grants, which is 5 years. What are you going to get?
60,000.
Not hearing you.
60,000.
60,000. So this will be the grant you're supposed to report for each year. Remember that the outstanding will be a liability, a deferred income, a liability in your position. What is left? What you have left will be a liability in that case. So yeah, if you want to get a liability figure here, it will be the 300,000 here. That's the total grant, and then the amount you record in profit or loss for the year one. Come here. And here we get 240,000. The 240,000 here becomes your liability. This liability, we can go ahead and then separate it into current and non-current. So if you want to separate it into current, liability, and then non-current. So we say current liability is a liability for 1 year. So we ask yourself, what is the next year's grant? The next year's grant, this year's grant is 60,000. Next year's grant will also be what? 60,000. So that's your current liability. Next year's grant is current liability. And then the rest becomes your non-current liability. So the rest here will be the total liability figure, which is the 240 minus the 60,000. So 240 minus 60,000. What are you going to get?
180,000.
180,000. When you're done, then present your statement. So let me do the presentation of a statement here. So statement of profit or loss. Let me see whether we have years here. 30th November. 30th April. 30th April. 2021. So yeah, you just bring your grants for that year, for 1 year in that case, which is 60,000. It's an income. Then comes the statement of financial position. 30th April 2021. And here we have non-current assets. Here we have an asset in the question. So we have to find for depreciation. So let me do that. Let's calculate for depreciation for the assets. Let me do that here. So depreciation, the asset is was 500,000. And divide by the useful life of the assets, which is 5 years. What's the depreciation of the assets?
100,000.
So here we bring the PPE figure here, which is 500,000, and then we have charged 1 year depreciation, 100,000. That will be left with 400,000 here. Then we show the government grants, what is left. So we bring a non-current liability aspect there, and then we bring the current liability. We have split the liability figure, the total liability to current and non-current. Non-current is 180. So you can just bring grants. Some also write deferred income, all the same. So yeah, 180,000 here. And then current liability here. We also have grants, which is 60,000. So we are done with the deferred income approach. Questions? If there are questions on the deferred income, I'm invited. Okay, so there's no questions. Let's go to the net off approach, which is usually simpler. So net off approach here. Yeah, what do? You need to find for your new cost of your assets. So we said here you subtract the government grant from the cost of your assets. So the cost of your assets here is 500,000. You subtract the government grant from it. The government grant is 300,000. Yeah. And then the new cost of your assets now will be 200,000. Now this 200,000, the usual thing you do is that you charge a depreciation. How do you calculate for depreciation here? To be 200,000 divided by the useful life, which is 5 years. So what are you going to get as a depreciation here?
40,000.
40,000. Then the next thing you do is to calculate for your carrying amount definitely of the assets here, which should be 200,000 now minus the 40,000, which you get as 160,000. Then you present. So yeah, first statement of profit or loss. The only thing I'm going to worry your head here is the depreciation. Which is 40,000. You do statement of financial position 2. You bring your non-current assets. So PPE. PPE figure here is 160,000. And you are done. So this is usually the net of. Quite simple. You just subtract the grants from the cost of the asset to get a new cost and charge your depreciation. You are done. So this is how you do the net off approach. So this is how you do the net off, and this is how you do your deferred income approach. Questions? If you have questions on this. Okay, so if there are no questions. We'll pick question 2 and look at that. So I read that question 2.
AB Logistics acquired an item of plant and machinery on 1st January 2017 to augment the setup of manufacturing facility in a deprived community. The plant and machinery cost 10 million Ghana cedis on 1st January 2017. The entity received a government grant of 1,500,000 Ghana cedis as support for the plant and machinery, and 1,500,000 Ghana cedis for salary for the first 2 years of the business, which commenced 1st January 2016. The plant and machinery have estimated economic useful life of 10 years and are to be depreciated on straight line basis. The entity accounts for government grant for assets using deferred income approach. The new account officer of AB Logistics has correctly recorded the acquisition of the assets, but credited the full grant received to revenue. Required. A. Pass journal entries to correct the error on 1st January 2017. B. Show extracts from the statement of profit or loss and statement of financial position for 2017.
Okay, so when you have a question of this nature, the usual thing, you first have to check whether there is a grant in the question. If you know whether it's a grant or a government assistance. In that regard, so let's check. Do you have a grant or we have a government assistance in this case? Do we have a grant or a government assistance? Yeah, we have a grant, right? The usual
Yes,
thing
sir.
I'll ask is what type of grant do we have here? Do we have grants related to assets or grants related to income? That's if it relates to an expenditure line. Which one do we have here? Do we have a grant related to assets or grants related to income in respect of an expenditure line?
Both.
Both.
Both. How do you know that it's both? Zaddy, go ahead. Zaddy's on his up, so go ahead. Okay, Isaac, you also said both. Why?
Because they said that 1,500,000 was in support of the plant and machinery, and then the 1,500,000 was for salary for the first 2 years.
For the first 2 years. That's true. For the first 2 years. So we have both for assets and we have both for expenditure. So you have to do it separately to be sure. So let me start with the asset. But we need to know the method we are using for accounting from the government grant. And yeah, the question has restricted you to use a particular method. You are using a deferred income approach. You can see that here. Once the question restricts you on a particular method, you don't have any choice than to use that same method. So here we are supposed to use a deferred income approach. How do we go about this? In this case, so we need to do it for separately. We need to do it for the assets separately. Then we come to the expenditure separately. Let's do the workings for that. Question 2. Let's start with grants related to the assets. We are doing the deferred income approach. And with the deferred income approach, you need to get our grants for a year, for just 1 year. How do we do that? We need to know the grants that relates to the assets. The grant related to the asset is 1.5, right? So we bring that there, 1.5 million. We divide it by the useful life of the assets. What's the useful life of the assets? 10 years, right? So 10 years. With that, we'll be able to get the amount for just a year. So 1.5 million divided by 10 years, what will you get? Now we want
50,000.
150,000. Oh? Yeah,
Oh,
when you're done,
1.05
your assets. Yeah, when you're done, your assets, you have to depreciate your assets. The assets, you need to calculate for the depreciation separately. So the asset, let's calculate for the depreciation. The cost of the asset is 10 million. Yeah. Start with 10 million. Yeah. Also divided by 10 years. So the depreciation here will be 1 million. Then calculate for the current amount, which is 10 million minus 1 million. That will give us 9 million. Then We are done with everything about the grant related to assets. The only thing is that here, remember that with the grant, we need to also separate it. When it comes to position, we need to separate it to know our liability. So first, let me start with the total liability here. Out of the total grants, how many have we used so far? We have only used one. So we have only used 150,000. So yeah, we do the 1.5 million minus the 150,000 here. What do we get as our standing grant?
1,350,000.
1,340,000.
350,000.
Okay, then this one we need to separate it between current and non-current. Now, how do we get the current? Current will be next year's government grant. So this year's government grant is 150. Next year's government grant will also be 150. So then we look for the difference to give you a non-current liability, which will be the total liability, which is 1,350,000 minus 150,000. So what's the non-current aspect?
1,200,000.
1,200,000. And that's how we go about it. Okay, let me check the dates. 1st January, so I think we are safe. Yeah. And let's go to the grants related to income. That's in respect of my expenditure line. So yeah, whenever it's grants related to income, bear in mind I've been it for you to cater for some expenditure line. So let's go to our question and look at the one that is for expenditure line. Let's look at what type of expenditure have they given to us. And then let's look at the number of years for it. So that's when you'll be able to determine whether it's for past cost or for current and future. So yeah, it says over here that 1,500 for salary. So that's a expenditure that relates to 1,500, 1.5 million for salary. And then the period involved here is they said for the first 2 months, when the business commence on 1st January 2016. Remember the year we are starting? We are starting on 1st January 2017. That's the beginning of the year. And then we're reporting at the end of the year. That's 31st December 2017. So yeah, they said from the first 2 years, starting from 1st January 2016, that should tell you that part of the amount of money relates to past cost. Or
yes,
part relates to past cost and part relates to what? Current. So if you want to get to know the part that relates to past cost, you just figure 1.5 million divided by the 2 years. It's only 2 years is the focus in this question. So let me do that. So grant for a year, in this case, there will be 1.5 million divided by 2 years. The expenditure is for 2 years. So each year will be 1.5 million divided by 2. What are you going to get?
750,000.
750,000. Now, for the 750,000, yeah, we have some relating to past costs. That's for 1st January 2016. So past cost. So past cost grants here, which is for 2016, right? Is 750,000. Then we have 1 for the current year. Current year is the 2017. So we left with 1 year, which is also 750,000. So in total, in 2017, the government grant you are going to record the whole amount. Bear in mind, the 2016 one was for past costs. And what does the standard say when it's past costs? Immediately record the full amount. And the full amount for the past cost is 750. And in 2017 itself, we have 1 year left, which we have to account for, which is 750. So in 2017, we are going to account for the two, meaning the 750,000 plus the 750,000. So yeah, you account for all the two, which will give you a 1.5 million. In this case, when you're done, then you present. So let's show the presentation for this. Name of entity will come AB Logistics. And statement here. Then it first December 2017.
I think the A said journal entries.
Journal entries. Let's finish this one. We'll do the journal entries.
Okay.
Okay. Then statement of profit or loss for the year ended. So yeah, what do we bring here? We have 2 grants you are bringing here. We'll bring that for the related to assets. That one is 150,000. And related to income, that one, the whole amount, that's 1.5 million. We sum the two up, what do you get? You bring it there. Next, depreciation. Then you bring out depreciation here. Depreciation here is 1 million. So let's add it to 150,000 plus 1.5 million. What do we get?
$165. 1,650,000.
650,000. Then we come to statements of financial position. Where are we bringing on current assets? EP. The current amount we calculated for 9 million, we bring there. And then we have some left of the non-current liability here. The grant, we have some left here. So non-current is 1.2 million. And then current liability is 150,000. And then we are done with this question. So let's go to the A aspects, the journal one. Question asks for journal. Let me do that here. So we need dates, details, debits, credits. So A says we should pass journal entries to correct the error on 1st January 2017. So we need to know the error they made. So yeah, it says the new accountant here of AB Logistics has correctly recorded the acquisition. That's the purchase of a non-current asset. They have recorded it. But I said, but credited the full grants received to revenue. Oh, he has recorded the whole amount to revenue, which is incorrect. So we need to write that off. How are you going to do that here? We need to debit revenue here to definitely write off the error they have done. And then we record a corrective. This one is only on the initial dates. It's on the initial dates. So the whole grant amount was 3 million. That's 1.5, 1.5. That will be 3 million. We write it off from the revenue. And then we account for it appropriately. At the initial, we are going to account for it as a grant. Then write your narration. Being correction of or being wrong posting to revenue. Now corrected. Questions on this? Questions on this? Okay, let's make progress. I think we are almost finishing. The next one is provisions. So provision will solve one question. Yeah. So maybe we'll solve the first question. The rest, try it on your own. So let's go to provisions question 1. So I read for us.
A company sells second-hand cars with a 6-month warranty that promises to repair the cars if any fault occurs following the sale. The company has estimated that 80% of the cars sold in the last 6 months will require no repairs. However, 15% will require minor repairs, and the remaining 5% will require major repairs. The company has estimated that if all the cars were to have minor repairs, then this would cost 100,000 cedis. And if all the cars were to have major repairs, then this would cost 500,000 cedis. Please go. Required. What is the closing provision?
What is the closing provision? So this is on provisions. This is specifically on provision. And provision, we have two major forms that a person can come from. You have one that is just from a single outcome and one that is from multiple outcomes. So in this question, we have from multiple outcomes. Let's talk about that before we solve. So 𝐼𝐴𝐺 37 provision. So if it's from multiple outcomes, how do you calculate for provision? To calculate for provision from multiple outcomes here, you always bring the probability of the event. So we always say it's going to be the of bring your probability of the event and multiply by the costs of the likelihood of that event to occur. So cost of the likelihood event. Let me just use cost of the likelihood event. So here in the question, we have two outcomes. You pick the probability of that outcome, multiply by the cost of the likelihood of that outcome occurring. Then move to outcome 2. Do the same to that. Then you add the two together. That's if you have just two. If it's 3, same, you do one for each of them. Pick its probability, multiply by its cost. Pick a probability, multiply by its cost. Pick a probability, multiply by its cost. When you're done, then you sum all of them together. So we're checking our question here. We have several outcomes. Yeah, so we have one for no repairs. Usually no repairs is not a big deal in the question. So we have no repairs here. That one, the probability here, they have given a probability to you in percentage. In percentage form in this question. The first one is 80%. Yeah. It said 15% will require minor repairs. So minor repairs too. We have been given that as what? 15%. Then we have the remaining 5% is for major repair. Major repair. That's 5%. In all, usually the event in all should give you 100%. That's if you had no repairs. In some questions, you may not see no repairs. Because no repairs here, if people don't come for repairs, the cost will be zero. So no repairs, that is, no repairs is usually not an issue. So yeah, we'll focus on the minor and major repairs. So we need to take a question whether we have been given a cost, estimated cost for minor or major repairs. The question says that the company has estimated if all the cars were to have a minor repairs to cost 100,000. 100,000. So yeah, I'll bring the cost here, 100,000. Then we do that for minor repairs, major repairs. That one is 500. So you multiply for each to get the expected value for each. So you sum them together and you're getting 40,000. This becomes your provision estimate. Provision estimate for this question. We are done. So this is in a case whereby you have more than one event. Let's pick one with maybe just a single event to augment understanding. We have done for more than one event. Let's do one for a single event. I think, yeah, we have one over here. So let's go question 2. Yeah, please read for us.
Question 2. HR company has a year end of 31st December 2018, and it was notified that on the 1st July 2018, former employee brought about a legal claim for unfair dismissal. HR company's legal team has said that it is probable that the HR company would lose the case, resulting in a payment of 495,000 on 30th June 2019. 𝐿𝐶 has a cost of capital of 10% per annum. A 1-year discount factor at 10%. A 1-year discount factor at 10% is 0.909. Required. Calculate the amount to be recognized in the financial statements of 𝐿𝐶 for the year ended 31st December 2018.
Okay, thank you. How do we go about for this? So consider here is just a single case. There's a legal case against you, and for legal cases, you need to make provision for that. But yeah, they say the amount of money here will be in the future. Yeah, bear in mind, we got a court case. We were notified on 1st July 2018. And the lawyers are saying that it's probable, our legal team is saying it's probable that we'll pay 495,000 on 30th June 2019. So let's check the period involved. On the day we were notified, which was 1st July 2018, and the day we are likely to pay their payments, which is on 30th June 2019. What's the period involved? What's the period involved? That's 1 year, right? Yeah, that's 1 year. So that means that you need to discount for 1 year. Because your payment here is in advance. To get your provision, you need to discount for 1 year. So for the second question here, to get our provision here value, let's bring the future value. And then we discount. So we multiply by our discounting factor. So our future value in this case, Our future value in this case is 495. 495,000. Then multiply by the discounting factor. It's 1 over 1 plus R. The cost of capital here is 10%. So that'll be, let me just add it to the 1. Yeah, so that's 1.1. Then raise the power 1 year. Raise the power 1 year. What's going to be the provision amount?
45,000.
We'll get what?
45,000.
45,000. And remember, once you do discounting, you need to always account for unwinding of a discount. You need to account for finance income or finance costs. Yeah, we are dealing with a provision amount. Provision is a cost. It's an expense to the firm. So it means that a resultant, we are going to account for finance costs. How do we get finance costs here? Same approach. Cost of capital. Bring the cost of capital and then you multiply by the present value. Then take into account the number of months involved. So we need to bring our cost of capital, which is 10%. Multiply by present value, which is 45,000. Then we look at the period involved. When was the date we were notified? That was on 1st July 2018. When are we reporting? 31st December 2018. What's the number of months there? From 1st July 2018 to 31st December 2018. How many months is that? Yeah, Zaddy.
Say, please, the provision I got 450,000, not 45,000.
Or 450,000. Not 45,000. Only 450. Okay. So the number of months. I thought you were coming to talk about the number of months. What's the number of months involved? So that will be 6 months, or that will be 6 months. So that will be 6 over 12.
6 months.
So what's our finance cost figure? What's the amount?
22,500.
22,500. The remainder that represents. So this is HR code. Statement of profit or loss. 2018. Bring a provision here. Here's 450. Then finance cost. Then we do position, statement of financial position. So when you're not carrying liability, yeah, the provision was just for 1 year, right? We discounted for 1 year, so it's just 1 year. You just do carrying liability. So provision, bring the provision amount here, which is the 450,000 here. Then bring our finance cost points. Finance costs always. It's 22,500. So then we are done with this particular question. Questions on this? Questions on provision? Okay, so if there's no questions, let's move to agriculture, IS 41. Let's look at that small. So let me give you a little background about agriculture before we come here. So IS 41, agriculture here, focuses on two major sides. We focus on biological assets, and para, and then agricultural produce. Now, one thing you know that IAS 41 does not recognize, so does not recognize bearer plants. So when you talk about bearer plants, yeah, you can take for instance a mango tree. A mango tree is a bearer plant. That one you use IAS 16 to account for it. So bearer plants are accounted for in their own separate standard. IAS 16 usually. So like mango tree, for instance, is a bearer plant. Yeah. You account for it under IAS 16. But the fruit from the mango is an agricultural produce. That one is covered under the standard IAS 41. So if you are dealing with the fruit itself, that one is an agricultural produce. But the bearer plant, the plant in itself, the tree, that one is not considered under the standard IAS 41. Then next is about the measurement rules. Let's look at the measurement rules here. Measurement rules, initial measurement, and then it has subsequent measurement. Initial measurement here is to measure at a fair value, less cost to sell. So that's how you measure it initially. Subsequent measurement is also same. That one too is fair value, less cost to sell. However, the standard says that in the case whereby fair value, so when fair value cannot be determined, realize I can't determine fair value. What do you do? If you cannot determine fair value, yeah, you use the cost less accumulated depreciation less impairment. In that case, that's in the case whereby fair value cannot be measured. And the standard goes ahead to say that when you compare at the year end and get a fair value gain or loss, make sure you account for it in your statement of profit or loss. So this is a little summary about the standard. Remember, it deals with biological assets. When you say talk biological assets, living animals as examples of biological assets, and agricultural produce. What you get from the biological assets, what we call as agricultural produce. So, for instance, a cow, you get milk from cow. So the cow in itself is a biological asset, but the milk you are getting from the cow is an agricultural produce. Then we come to the measurement proceedings. Yeah, we have the initial measurement and the subsequent. Initial measurement is fair value less transaction cost. Subsequent is the same, fair value less transaction cost. But the thing you need to remember that in some instances, fair value cannot be determined. In that instance, you rely on the cost less accumulated depreciation less impairment. So this is how you go about that. Let's come back to our question. So please read our question for us. I read that wrong. I think she has left us. Can we get a different person?
Okay, IS 41, agriculture. You are the accountant of Golden Bean Farms Limited. The company owns 10,000 cocoa trees. During the year, management spent significant amounts maintaining the trees and nurturing the cocoa pods growing on them. At year end, cocoa trees have a carrying amount of 3 million Ghana cedis. Cocoa pods growing on the trees have a fair value of 1.2 million Ghana cedis. Cost to sell the pods are estimated at 100,000 Ghana cedis. The finance director wants to account for both the trees and the pods under IS 41 because they are all part of agriculture. Required. Advise the finance director whether the cocoa trees should be accounted for under IS 41 or IS 16. B. Calculate the carrying amount of the cocoa pods. C. Explain the difference between bearer plants and agricultural produce. Then state the effect on profit or loss.
Okay, so let's start with A. A here. A, the acting of cocoa tree. Should we account for it under IS 41 or IS 16? What will be the answer? Yeah, go ahead.
IS 16.
IS 16. Why? Why IS 16?
Because it's a bearer plant.
Because it is a bearer plant. Yeah, it bears cocoa. It's a bearer plant. So that's all for A. I'm going to account for it under IS 16. Then we come to B. The B is acting as to calculate for the carrying amount of the cocoa pods. But man, cocoa pods is gotten from the cocoa trees. So pods here is an agricultural produce. So if it's an agricultural produce at the point of harvest, we measure it at what fair value less transaction cost. So we have to pick the fair value in this case. And the fair value here is what 1.2 million. And then we less the cost to sell, which is 100,000. So subtracting that will give you 1.1 million. That will be your carrying amount of your cocoa pods. You're done basically with that. The rest is just asking you for theory. And you see the effect. So the effect here is that if you are the one selling, it'll form part of our revenue, but if you are the one receiving, it'll form part of our cost of sales. In that regard. I think that's basically the major thing of this question. You've been able to identify that cocoa tree is a bearer plant, and then second, you've been able to estimate the value of your cocoa pods. So this is basically on the agriculture, nothing much. We go to our last one, last question for the day, then we close. Yeah, we have just some few minutes to time. IS 24, related party disclosures. Related party disclosures. So you can see a diagram here which shows the percentage of holdings and then the relationships over here. Let's look at the additional information and then look at the required. So I read the additional information first.
Okay, so additional information. 𝐼𝐧𝐬𝐿 PLC shares control of 𝐼𝐧𝐬𝐿 Limited with another company, BRCA2 PLC, which owns 30% of 𝐼𝐧𝐬𝐿 Limited. Under an agreement between 𝐼𝐧𝐬𝐿 PLC and BRCA2 PLC, all decisions about operating and all other activities are made jointly. In all other circumstances above, percentage shareholdings are equivalent to voting rights and influence. 𝐼𝐴 Limited is 𝐒𝐵𝐾 Limited's main customer, representing approximately 55% of 𝐒𝐵𝐾's revenue stream. Ivan, Dennis pays monthly upkeep allowance to Adoko. Required. Justify whether each of the parties in the above diagram is or is not considered a related party of 𝐼𝐸𝐿 Limited in accordance with IAS 24 related party disclosures.
Yeah, so we are looking at each, the question is each party to 𝐼𝐸𝐿. So whenever you're doing analysis, you have to pick for each party. So bear in mind, we are comparing all of them to 𝐼𝐸𝐿 Limited. So we'll start from here. Let me start from the one we have here, 𝐼𝐸𝐿 and then 𝐼𝐸𝐿 Limited. 𝐼𝐸𝐿 and then 𝐼𝐸𝐿 Limited. 𝐼𝐸𝐿 and then 𝐼𝐸𝐿 Limited. There is some percentage of control, percentage of shareholdings like 5% here. Does this constitute as a related party transaction? They have written it here. Who 𝐼𝐸𝐿 is. Say 𝐼𝐸𝐿 Limited is 𝐸𝐸𿠗's main customer, representing approximately 55% of 𝐸𝐸𝐿's revenue stream. Is that a related party transaction? So we are comparing 𝐸𝐸𝐿 with 𝐼𝐸𝐿 Limited. They have given us information that 𝐼𝐸𝐿 is a major customer. So is 𝐼𝐸𝐿 a related party here or not?
𝐼𝐸𝐿 is a related party.
You said? Who is speaking? Okay, Robert in the comments is saying that it is a related party. Robert, can you tell us why? If you can unmute and tell us why you think so.
Please, because they have 5% voting rights in the campaigns.
Because we have 5% voting rights in the company. Okay, because we have 5% voting rights. So that's what Robert is thinking about. Any other? Do you all agree?
So can I try?
Yeah, Avi, try.
Yeah, I think they are not related because related parties, it's either there's control, that's the 50% and above, or it's an associate or joint control.
Yeah, so but this one is not control, right? Just 5%.
Yes,
And it's just a major
5%.
customer.
Yes, please. So they are not related.
Okay, that's correct. So in the IAS 24, if you are looking at 𝐸𝐸𝐿 and 𝐼𝐸𝐿 Limited, this is not related. This is not a related party transaction. And yet the reason is that this percentage we have doesn't give us associate, doesn't give us subsidiary, doesn't give us joint control, doesn't give us joint venture. In that regard, it's 5%. 5% is very, very minimal. Although it's a major customer, it's still not a related party. Then we'll check another party too. So 𝐸𝐸𝐿 and then 𝐼𝐧𝐬𝐝 PLC. So 𝐸𝐸𝐿 and 𝐼𝐧𝐬𝐝 PLC. Is it a related party or not a related party?
Related party.
It's a related party. Why is it a related party?
It's an associate. They own 25%.
Exactly, associates. So there's an associate form of a relationship over there. Next, we go to Miracle and Miracle Limited and Ahmed Limited. Miracle and Ahmed. Miracle and Ahmed. Is there a related party?
I see.
No.
Related.
Some are saying no, some are saying yes. So let's take those who are saying yes. Why are you saying yes? And those who are saying no,
So,
why are you saying
Ayaga and then Ahmed, or Reku and Ahmed. Sorry.
Miracle and Ahmed. Remember,
Reku and Ahmed.
our focus is Miracle. So we are looking at all the parties to Miracle. So our focus is Miracle. So Miracle and Ahmed.
You said they are not related.
They are not.
They are not related.
Yes, please.
Why?
Because it
Why?
seems Ahmed is a subsidiary of 𝐼𝐴 and not related to Miracle from the diagram.
Okay. But I think it said something over here. Oh? Do you have that? It said 𝐼𝐴 PLC shares control of Ahmed with another company, Rakatu PLC, which owns 30% of Ahmed. See, under an agreement between 𝐼𝐴 PLC and Rakatu, all decisions about operating and all other activities are made jointly. Okay, so yeah, they didn't mention Miracle.
Yes, sir.
Says Ahmed.
So you think it's not a related party transaction? It is so.
Is it joint control?
If it's joint control, that will mean that 𝐼𝐴 and then Miracle are owning the thing together. But as it stands now, the question didn't indicate that, so I can't say that emphatically. The basis of my assumption is that yeah, Miracle has purchased 𝐼𝐴 25%, and 𝐼𝐴 has purchased 70% in Ahmed. So indirectly, you have a stake in Ahmed. I know we are not done. I know that for FRI we don't do indirect control. I think we do that when you're doing CR. So in CR you get to see that you may have an indirect stake in another company. A has purchased B, B has purchased C. Indirectly you have a stake in C.
But
So,
the 17, it's going to be 17.5%.
17.5%. That's less. Let me see. You calculated for it. That would be approximately 19%. So actually, that's 17.5. When I calculated, I had 19%. Approximately 19%. Which is close to associates in that case, which is close to associate. It's not, although it's not a perfect, it's not close to associate. Associate is 25% off going, so it's not close to associate though. But yeah, we are saying you have an indirect stake in Ahmed because of 𝐼𝐴. You have an indirect stake in Ahmed. I don't know. I think I might made some adjustments to this question. Yeah, so yeah, you have a stake in Ahmed. And the reason being that yeah, 𝐼𝐴 is under joint control. 𝐼𝐴 shares joint control of Ahmed with another firm, and then Miracle has a significant influence in 𝐼𝐴. So indirectly, you may have a stake. You may have a stake in it. So there may be some form of related party transaction there. As to whether it's going to be significant or not, that will be a discussion you will later discuss But yeah, I would say there is some form of related party transaction. In this case, let me move to 4. 4 still based on Miracle. Now let's come to Miracle itself. Who is Alex? Miracle here is Alex, the CEO of Alex. We look at Miracle Alex with Adoko. Adoko, yes, it says Alex domestic partner. So we look at Miracle in the person of Alex and Adoko. Are they related party transaction? So Adoko is Alex's domestic partner. So more like this one, Alex's wife also. So is it a related party transaction?
Yes.
Yeah, because it's the person's a wife. Family relation, right?
Yes, sir.
Yeah, so related party transaction. Yeah, I should even talk about Alex and I should even talk about Alex and the American Limited. No, about Alex and the American Limited.
Related party.
Yeah, this is also a related party transaction. Why? The standard says that if a person is a key management personnel, so key management personnel, and then yeah, Alex is a key management personnel of the firm. So then we have Alex and the twins. In the diagram that was down there, twins. Alex and then the twins. They say the twins are Alex and Adoko's 4-year-old children. So Alex and the twins, are they related party?
Yes, sir.
Okay. So yeah, related party because of family ties. So related party transaction. Then we have 7. Yeah, which is Alex and then Dennis. Who is Dennis? The diagram has said who Dennis is. So Dennis is Adoko's former spouse. So we have Alex and Dennis. We have between that. Dennis is Adoko's former spouse. I think the additional information also says something here. Ivy. It said Dennis pays monthly keep-up allowance to Adolfo. So Alex and then Dennis, are they related party transaction?
No.
No, why I say no? Why I say no?
I'm looking at it in the sense that Dennis is a former spouse, so he can't really influence.
Okay, you're right. Maybe it was just Alex and then Dennis. Based on that Adolfo is former spouse, and I agree with you that there's no related party transaction. But bear in mind, look out, Dennis is giving Alex's wife upkeep allowance. Does that not count for anything? Does that not mean that he can have an influence when he's dealing with Alex?
But it won't harm him if he doesn't know that it's coming from Dennis.
You're thinking too much beyond the question. That's just based on the face value. The question that they have given us the information, being that he's aware. Being that he's aware. Let's not just go outside the question.
Okay, so I think there's a dilemma here. If he can maybe exert some significant influence, then he is. But if not, he is not.
Yeah. But the saying that the person who gives you money controls you enough. Yeah, so once Adoku is taking some form of money from Dennis, if Adoku and Dennis are no more and then they don't have any relation again, then Alex would even not have any relation to do with Dennis. But yeah, Alex will have a relation to do with Dennis because Dennis is giving Adoku some form of allowance in that case. So yeah, there is. There is a related party transaction. And yeah, the reason is because Dennis is a sponsor of Adoko. Then the eighth one, I think that's the last one. Alex and I saw another NC, is it Jinapo? Alex and Jinapo Limited. So let's see, Alex and Jinapo. Is there some form of relation? Alex and Jinapo, do you have some relation?
No.
No, why? Why no?
So from the chat, it looks like Jinapo is an associate of Dennis,
It's not
more or
really
less.
associates.
No, so it
Yeah,
doesn't really, he doesn't influence.
exactly. So this is not a related party transaction. Finally, Mark, we are done. We are done with the standards. So in the next meeting, I think we have one last meeting. We'll look at evaluation of financial statements. And we'll touch a little about the frameworks as well. Thank you all for joining today's discussion. We'll meet subsequently. Bye-bye.
Hey, what's your number? What's your number?
Oh, I'm on the platform.
But
Are you on
you
the
give it to
platform?
me. I traveled, so I came not long ago. So if you can give it to me, I'll be very happy.
Okay. Let me put it in a chat box.
Okay. All right.
So this is my WhatsApp number.